Welcome to the final virtual showcase of 2021, the Emerging Small Cap Summit. Now, I say that, and my biggest hope is that the next time that you'll be seeing us is live and in person at our Emergence 2022 conference, which I'll talk about at the closing of the event. Now, today is where you'll have the opportunity to discover the next generation of growing pre-IPO, IPO, and small cap listed companies. Now, if you've been following us for any amount of time, you know that the incredible track record we've been having in actually discovering these companies very early in their growth cycle. And in fact, we've now had several companies go on to become unicorns and many that have gone on to become, sort of 100 million, 500 million, etc. and above. So for us, this is a very exciting space, and we've been able to successfully year on year discover some of the most exciting emerging small cap listed companies. Now, this exclusive showcase is brought to you by obviously us, Wholesale Investor, and is done in cooperation with our good friends at Peak Asset Management. Today, you'll hear presentations from more than 15 companies in the sectors of mining, oil and gas, e-commerce, governance technology, life science, financial services, renewable energy technology, and more. As a keynote speaker, we're really pleased to have Paul Hopper. Now, I've been working with Paul now for the last decade, and in this last sort of 12 to 24 months, the companies that he's been behind and been working with have gone on to become some of the superstars of the ASX. And likewise, Paul's profile has built exceptionally in that time as well. So some of the companies he's involved with is the founder of Radiopharm Theranostics, which has been covered recently in the AFR, Chimeric Therapeutics, which listed this year, and the one which everyone is talking about, which has been a stunning performer, which is Imugene. Now, to give you some history on Imugene, the first time that Wholesale Investor worked with them, they were presenting at 0.01 cent, right? To give you some perspective. And now now you can see where their share price has gone. I think it was like a 20 or 30 million market cap or something like that. And obviously now they've crossed sort of $2 billion. Now, we also have lined up an incredible panel session with fund managers and deal makers. And there's two components to us, really sort of looking back on 2021, what were the key thematics which drove the investment markets, and then discussing what's coming up in 2022. Now, we're obviously at a volatile time where obviously there's been some record sort of price gains from some emerging growth companies. Likewise, there's potential in facing headwinds. And for investors, as always, we know that these times bring out the inner bull as well as that inner bear sits there as well. So it's going to be fantastic to listen to the deal makers and think how they're going to be approaching these markets. And also, as we know, even in down markets, whether it's up or down, there's always opportunities to create, to make money and to create wealth in those times. So looking forward to that panel session. Love listening to both the fund manager aspect and also the deal maker aspect. So I welcome you to the Emerging Small Cap Summit. Enjoy the event.
Paul Hopper has over 20 years experience in international public company markets, primarily in the medical, healthcare and biotechnology sectors, with a focus on startup and rapid growth companies. He has served as either chairman, non-executive director or CEO of 14 public companies in the US, Australia and Asia. His experience includes 4 IPOs and 2 public company mergers, as well as extensive capital markets experience in debt and equity raising in Australia, Asia, US and Europe. Paul is now the managing director at the Los Angeles-based Capella Capital, where he is head of the life sciences and biotechnology group, responsible for mergers and acquisitions and capital raisings. Enjoy the interview. Thank you for joining me today, Paul.
Thank you for having me. Pleased to be here.
Well, just to get started, we're going to allude to your past for a second. You've been behind a number of successful oncology biotechs, and your latest venture is one of the few Australian companies in the radiopharmaceutical space. Can you perhaps expound upon your powers of perception when it comes to discovering new technologies in these spaces and the obstacles along the way to those discoveries?
Yes, certainly. So the radiopharmaceutical one is quite an interesting space because in Australia, we have 2 existing listed companies. The first one is Telix, which has been incredibly successful, and the second one, which is Clarity, which has just come out as a listed company last month. I wouldn't describe myself as having powers of perception as such. I've been in the sector long enough to sort of look for things that stand out and give you a feel as to whether you should proceed. So I lived in the States for 11 years, and I became very well connected to the major medical institutes and research centres in not only in America but also in the UK and Europe, which have given me the opportunity to find technologies. I'm not a scientist, but I have a deep network of experts who I seek guidance from, and they probably polish my perception, if you to use the word. And I look for sectors that that show great promise or are so to speak hot. And 5 or 6 years ago that would have been immuno-oncology. More recently it's been cell therapy, and even reference to the radiopharmaceuticals. So I use my networks, my experts, and I go around to the various institutions seeing what they have that's available for license. So that's how I basically find new technologies.
Absolutely. So you've definitely alluded to that network of experts you use there, which sort of leads me to my next question around how you actually fell into this sector. You're a political science major out of the University of Sydney, and with that you took on obviously the world of entrepreneurship, and you started and thrived in the space of health and biotech. What drove you to this sector in particular, and this way of this living, I guess?
Yes, well, I guess a political science major is not really. There doesn't seem to be much of a connection there, but I do have to say that my head scientist and founder of the oncolytic virus technology, Imugene, Professor Yuman Fong, who's one of the most brilliant physicians and scientists around, his first degree was medieval poetry. But look, I started life as a stockbroker, and then I joined an investment bank. And then when I was young, I saw the opportunity to become the CEO of a small ASX-listed hospital company, which was acquired by Ramsay Healthcare. And when that was acquired, I went off to the US to have a look around, and I met some oncologists, and I got exposed to the biotech sector. And that was like someone flicking a switch, and that set me on my way. So I found it incredibly exciting and thrilling. The people were brilliant to talk to and deal with, and was the best decision I made to get into the life science sector.
Absolutely. And what, just out of interest, what did flick the switch? What was it about the sector that really attracted you and enticed you to stay on that journey, Paul?
Well, look, I met an oncologist from Yale University who was studying prostate cancer, and I asked him to explain the science, which was completely and utterly obtuse to me. I had no way of really understanding what he was saying, but when he told me what he was trying to achieve, I thought it was astonishing. It was peering into, the almost like the origins of life, so to speak. And that for me seemed terribly exciting. And then I saw this enormous biotech market and life science market in the US, massive, and the money going into it and the intellectual horsepower being applied to it. I thought, yeah, that's a good place to be.
Amazing. Now, I mean, with your ventures in the space of life sciences, I'm sure you've picked up on a lot of best practices, as well as stumbled upon your own ways of doing things. But in terms of identifying an opportunity, as well as carrying it to an exit or a listing, now, obviously that's a careful balance of two aspects, which is both research and commercialization. Do you find that entrepreneurs in the biotech space, for instance, in the life science space in general, are often struggling to make that balance or keep that balance between the research and the commercialization aspect of their ventures? Yeah,
well, there's sort of three types of people in terms of entrepreneurship in the sector. I think there's the pure scientists. Then there's those that are not scientifically trained, like myself, and then there's the third, who are a hybrid of business and science, who have made the transition out of the scientific world and can do. They're not that common. They can do quite a good job of it. For me, I'm not scientifically trained, so I have to make sure that I've got experts supporting me. So when I look at a piece of technology, obviously I want it to come from, I want it to be in a sector which is showing great promise, as I mentioned earlier on. But I always ask myself, is is this investable? Can you build a story around it that investors will be excited by it? I say to myself, is the drug or the technology really druggable? Is there a product to be had at the end of the story can it get approved? So I think it's a blend. Not a lot of scientists make the transition over into a fully blown commercial enterprise that may go public. Some of them do,
Yep.
but not a lot, because that's by definition they're not trained for because capital markets are an enormous part of a biotech company, because half your life is spent raising money, because they tend to be black holes for capital for many years. So I think having some knowledge of the capital markets is a definite advantage.
Do you think, especially for those early on who don't have access to all the time to attain the level of knowledge needed to do that successfully and effectively, what sort of advice do you have for them in terms of reaching out to people who can help them along with that journey?
Yes, look, it's a difficult one. In the early days, a lot of biotechs have to, fund out of their own pockets or with friends and family, and I find a lot of those companies have very unrealistic valuations, because it's a very easy exercise to pull up a whole list of companies in the same space
Yes.
that are worth a fortune and say you're the same, therefore your valuation is this. So I think you have to be very realistic in the early days about the main thing is to get the money to get the project going, get some drug made, start doing some preclinical experiments, start producing some data. And if the technology is as good as you think it is, and the data comes out nicely, then the money will follow.
Okay.
But in the early days, you might have to swallow your pride a bit on valuation and give away more of the company than you wanted to give away, because it's your baby and you own 100% of it now. But one thing's for certain, you're on a path of dilution for the next 5 or 6 years for sure.
Absolutely. So in one of your past interviews, Paul, you mentioned that the VC ecosystem isn't perhaps deep enough to support many early stage biotechs in Australia. And I assume by deep enough, you're referring to the amount of capital available for these biotechs, and they're not willing to deploy that amount, a suitable amount of capital to these companies. Is that what you were alluding to?
A little. I think, look, unlike the US and Europe, biotech is not yet an established asset class in Australia. It's getting there. And the number of life science funds or hedge funds that are buying biotech equities is certainly going up. I mean, compared to 5 years ago, there's substantially more interest in the sector. But and the VC sector, though, is not anywhere near the size as one might expect. It's growing. I mean, one wag said to me once, well, all the adventure has gone out of the venture capital community in Australia because they're very cautious and they take a long time to make up their mind. We don't have very many dedicated life science analysts, for example, in Australia. There's a lot of analysts working for brokers and banks that are actually not scientifically trained, but they are writing research on life science and biotech companies. So there is money here, there's no doubt about that, but the VC system is still growing.
Absolutely. And so I guess that prompts someone who is starting on their journey and looking to raise capital to look beyond Australia. Is that what you would suggest? Because if there is that gap in capital, a lot of good ideas may go, to this mass graveyard if they're not, I guess, number one, effectively communicated to the investor market. And even if they are effectively communicated, there's a lack of interest in the Australian market. So are you seeing a lot of that going offshore from the top research entities here in Australia?
Well, look, if you're a small startup, private biotech, the chances of getting funded out of the US, in my experience, in my opinion, are pretty close to zero. I'm not saying it doesn't happen, but it's uncommon. If you're a small listed biotech company, sub 100 million, you're a micro cap company, and that's also pretty tough because you've got to think that someone deploys 2 or 3 million as an investment in you, and your daily trading's $30,000 or $40,000 worth of stock. How do they ever get out of it? It would take them forever. So the market for both the investor appetite in the US for private and small publicly traded biotechs out of Australia is the tough one. I mean, I'm not saying you shouldn't go, because I have gone over the years to every VC under the sun and to all the investor conferences and that. I think it's worth pitching at them and being there and asking them to take a meeting. But I think in the early days, it's a struggle to get money out of them.
Paul, when you're called up to take up one of these positions at a listed company, what would you say is the first point of action? What is your process of identifying the issues at hand and obviously pursuing those solutions?
Right. Well, I generally don't take positions on listed companies that I don't have a major interest in. But, you know, where I have in the past, those sort of things you just asked me, you should, just as a matter of due diligence, you should have already sorted those out. So, I mean, the process of taking a board position, I think, or the decision to take a board position on a listed company is a serious one. So you need to be pretty comfortable that you know what's going on in the company, and you should identify those issues beforehand, and where you feel they need to be resolved or solutions. My advice would be you probably should sort that out with the chairman of the company before you join, because you might find there's not a commonality of views about what you're concerned about. So my response to that question would be, do your DD first and then make up your mind whether you want to get on board, and make sure that if there are changes needed, that other people on the board agree with you.
Excellent. Well, it brings me to the next point. So you, as you mentioned, you are the founder and you have an interest in these companies. You are the founder and have been the executive chairman of 3 life science companies listed on the ASX currently. You're the founder of Emergence, now known as the largest biotech in Australia. What have you seen across this portfolio of experience in terms of fundamental drivers to the success for the growth of these companies that you've been a part of and have founded?
Are you asking in reference to being a director, or just the success of the companies generally?
The success of the companies generally, correct.
Yeah, so I think they have to be in a sector of life sciences which is, to use a crude term, on fire. So that would be things like cell therapy and CAR-Ts, immuno-oncology generally, maybe checkpoint inhibitors, and as I mentioned, something like radiopharmaceuticals, which I think are really coming into their own. You need to make sure that the intellectual property is sound, because most biotechs, not all, but most, don't own bricks and mortar. Their main asset is their intellectual property. You need to have a very, very good management team, because after the technology, the most important thing in a biotech is the management team. And you need to have a management team that have very specific domain experience relevant to the technology, because a lot of it, well, certainly in the technologies I'm involved in, it requires a high degree of expertise to know how it all works. So just having a generalist sort of person, I don't think cuts it. You've got to have a clear path to the clinic. So if the drug is not already in a clinical trial, for me, you have to have a line of sight to when it's going to get into the clinic. And I don't think the capital market has much of a tolerance for anything which is more than about a year away or so from going actually into the clinic. And you want to see some evidence on why you think the drug works. In other words, what does the preclinical data show that the drug does? Now, we've known for years that what happens in a mouse model when you cure cancer doesn't translate into humans, but you should at least have compelling preclinical evidence that the drug has activity and has the chance of working.
Absolutely. And along the same line there, Paul, I want to ask you this final question in relation to the cancer therapy company, Chimeric Therapeutics, which you obviously successfully led their raise, which was 3.5 times oversubscribed. So you led that raise. It's an important question because I'd love to have you abstract from the success of this story. What can we take from the success of this story in order to help other CEOs, founders who will be raising quite soon or raising after watching this interview, in terms of ensuring a raise like that that's oversubscribed and successful?
Yeah, look, I was lucky that I was able to acquire the technology from a leading cancer center in the US called City of Hope.
Mm-hmm.
It was a drug that was about to go into a phase 1 clinical trial. Those drugs are hard to find, particularly given it's in an extraordinary area, which I've alluded to or commented on. This is cell therapy, so CAR T therapy. The provenance of the drug, not only from the institution being City of Hope, but the inventor, Professor Christine Brown, extraordinarily well-regarded scientist. The preclinical evidence, that is all the experiments she'd done leading up to going into the phase 1, was very powerful. The drug had good IP. The drug had already been sent to the data package had already been sent to the FDA to get an IND, which is the regulatory instrument that allows you to run a clinical trial. And then on top of that, I was able to poach the chief medical officer from Legend, which was the largest biotech IPO on NASDAQ last year. I was able to poach the chief commercial officer out of Kite, which is arguably the most successful CAR T company in the world. So I had a management team like no one else, and packaged it up, and people could see that patients were going to get the drug very shortly. So I had a nice confluence of all the right ingredients that brought it together. So, but I think the reason it was successful and it resonated is because the science was an area that was very, very promising. Again, to use the word, it was a hot area of science in the biotech field, and it was very close to a clinical trial. So if you get all those ingredients, I think the investment community respond pretty well.
Absolutely. It goes to what you were saying before about getting the right components and the right story to tell the investor community as well. And it seems like all those factors were there. Well, Paul, thank you so much for joining me today. And hopefully we can talk again in the future, and best of luck with your ventures.
Thank you very much for your time.
Thanks.
Hello, this is Simon Kidston from Genex Power. Today, I'm joined by James Harding, CEO of Genex Power. The image you can see in front of you is our flagship pump hydro and renewable energy site in North Queensland. Genex Power is all about producing clean, green energy into the grid and providing strong cash flows for investors. You can see that we're a diversified portfolio. We're diversified by technology and we're diversified by geographic location. In North Queensland, we've got an operating solar farm backed by a long-term contract with the Queensland government, providing very strong cash flows to the business. We're in construction, having fully funded a pump hydro project, a giant water battery, which will provide very, very strong cash flows for the business when it's operational in 2024. We're also developing a battery project in Rockhampton. The Baldercombe Battery Project is partnering with Tesla, and that project will be in construction early next year. And finally, rounding out the portfolio, we've got an operating solar farm. It's been generating since June of this year and is expected to double our revenues this current financial year. So in summary, 100 megawatts of operating assets, 250 megawatts in construction, and a very strong pipeline of growth assets focused on renewable energy generation. There's a big structural change which is going to provide a tailwind for this business. And essentially, there's a gradual retirement of coal-fired generators as the economy decarbonises, and that capacity is being replaced by wind and solar generation. And of course, we know renewable energy is green and clean, but it doesn't always correlate with when energy is required by customers. And that really comes to the heart of the Genex business model. We're very focused on providing energy storage to capture clean energy when it's generated and dispatching that energy into the market when consumers need it. So there's a very strong tailwind that will underpin our business for decades to come. In terms of our business, I like to think that everything we do has got a very clear focus on deriving returns for our shareholders. This pie chart here illustrates our revenue forecast and guidance all the way out to 2055. Each of the projects we're building or operate are backed by long-term contracts with tier one counterparties. And what that enables us to do is provide very clear understanding of the revenues and over time dividends that will flow through to our shareholders. In fact, the scale of these projects is significant, averaging some $82.5 million of committed revenue year in, year out, per annum, all the way to 2055. We've locked in our operating costs, we've locked in our interest costs at very, very attractive pricing. So we're able, over time, to pay a significant portion of our free cash flow to shareholders in the form of dividends.
Thanks, Simon. Very good to be here and a very exciting time for Genex in this energy market transition. And our flagship pumped hydro project, which Simon referred to on the previous slide, we're delighted that we've got that under construction this year. That'll be a 3.5-year build and is very timely to bring what will be the first pumped hydro project in the country in 40 years. And when it's built, the third largest electricity storage device to market at this very important time in the transition. We have a lot of advantages with this project. We have a low capex, which is created by the existing infrastructure from the old Kidston Gold Line, which we're repurposing. We use the two existing pits as the upper and lower reservoir, and we use the old mining camp, which we're turning into a construction camp. And it's a big employer up in the north part of Queensland, 800 direct jobs created. So we have very strong support both from the federal and state government and a lot of funding, low-cost loans from the NAIF, the North Australia Infrastructure Facility, the largest ARENA grant in their history, and a strong contribution from the Queensland government for the power connection. A few photos showing the construction progress at site. On the top left, you see the old mining camp, the Oaks Rush, which is now a construction camp able to accommodate 500 construction staff. On the right, you see the dewatering of the lower reservoir, which is underway. And in the middle, you see a schematic of what the upper and lower reservoir will look when it's built. And along the bottom, you see we're now well into progress on the 3.5-year construction program and will be fully operational at the end of 24. So we're using that knowledge that we've gained in the last 3 years developing the pumped hydro project about the energy storage market, especially in Queensland, and all the high value revenue streams which are available to energy storage operators. And we're applying that to a battery program, which we're now rolling out initially in Queensland and ultimately across Queensland and New South Wales. The first project is the Baldercombe Battery Project. That's a 50 megawatt, 2-hour storage battery at a main substation in central Queensland. We're actually locating the battery on Powerlink land inside their substation. You can see on the picture. So very close to the connection point in the substation bay. We selected Tesla as the supplier, and they're the most experienced battery supplier in the world, and certainly in the Australian energy market. We're well progressed with an offtake arrangement, and we hope to bring that to financial close and start construction around the end of this calendar year. So we selected Tesla. It's a very well-known brand name, obviously in the storage sector. And we've selected their latest technology, the Megapack 2.0, which is an all-in-one utility scale energy storage system, which has been optimized for cost and performance. And all the components are pre-installed in the single enclosure you can see in the picture there, at the Tesla Gigafactory in the US and shipped as a single package to site, and includes the battery modules and an integrated cooling system, which again is optimized for safety, performance, and reliability. So what we're doing with this project is we're securing a certain amount of debt based on this offtake arrangement, which is nearly complete, which gives us a fixed baseline revenue, but it gives us upside as the owner to retain some of the very strong revenues that we get from energy storage. There are two markets basically that storage play in. Obviously, there's the energy arbitrage, so the difference between generating or charging the battery when prices are low, or in Queensland when prices actually run negative during the day, so you get paid to charge, and then generating in the evening peak when prices are high and consumer demand is high. So that margin is a big chunk, and that's the green line on the chart there, is that energy arbitrage. The blue line shows the other revenue streams, which are ancillary services, so frequency control and voltage control. These are markets that you get paid for by being able to respond very quickly with your battery to charge or discharge within milliseconds and gain revenues that way. And we've seen with existing batteries, the big battery in South Australia that Tesla constructed, for example, has made huge profits from those ancillary services revenues. When problems occur on the electricity market, those batteries can respond very quickly. And we see in Queensland in particular a really good business case for this kind of a battery project. It's a much lower capex, obviously, than the pumped hydro, so we're able to have this more flexible financing arrangement. We do get a 20-year warranty from Tesla, which is a big improvement on the market standard for batteries. And again, a very strong EBITDA margin of over 75%. Just to recap, we have two existing fully operational solar farms, one at Kidston, which has been running since 2017, one of the best performing solar farms in the country with a 33% capacity factor and an outstanding 20-year power purchase agreement with the Queensland government. And Gemelong, our newest solar farm, been operational since June this year. And that again is very well performing, is currently selling into the spot market and achieving equivalent revenues for us. And the Kidston Wind Project, so up at Kidston, we have a solar farm operating, we have the pumped hydro under construction, and we will complete the clean energy hub with the Kidston Wind Project, which is up to 200 megawatts of wind located close to Kidston in what is a very good wind resource, as we've discovered. And our partners, J-Power of Japan, who are an investor in Genex now, are partnering with us to co-develop this project on a 50-50 basis, applying their development funding capital and also their technical expertise. So we expect to complete that development and start construction in 2023 and connect it into the transmission line that's being built for us at Kidston when the pumped hydro starts operating. So just to summarize, Genex is a diversified renewable energy and storage company, both diversified by technology, but also by geography. We have the two solar farms in operation already. We have the pumped hydro now under construction and coming into operation at the end of 2024. We have the first of our strategy of new battery projects at Bouldercombe. We'll start construction early next year, and the wind project will complete our portfolio by 2025. So as I say, exciting times for Genex and for our shareholders. Thanks very much for listening.
Hello, ladies and gentlemen, and thank you for the time to listen to the White Rock story. We're a small junior resources company listed on the ASX, and we also have a cross-listing in the US on the OTC. We have 3 projects, and I'm going to spend the next few minutes telling you all about these 3 projects. As we are listed on the ASX, we do have the obligatory disclaimer and cautionary statement. I won't read that to you now. You are more than welcome to read this at your leisure. It will be on our website. A question, I guess, for the listener is, why would you think about investing in White Rock? Now, clearly you need to do your own research, and this is not financial advice, but my role is to explain to you the story, and I think hopefully the opportunity that you will see in investing in this business, in our company. So a few of the important points: the asset base. What is White Rock? Well, we are a junior resources company, as I mentioned. We have 3 commodities in 3 jurisdictions, all offering multiple opportunities. And so I think from a de-risking point of view, not all eggs in one basket, across the commodities range, but also jurisdictions, very important. As I mentioned, the 3 projects, they are in first world jurisdictions. We've got a large land package here in central Victoria. I'm based in Ballarat. We've got a very large land package in central Alaska, part of the USA, and Alaska is rated in the top 5 of the Fraser Institute. And we've also got a large tenement package in New South Wales. So all first world jurisdictions, all follow the rule of law, all speak English. And I think that's very important for the investor. You know, there are some wonderful projects in some wonderful parts of the world, in Africa and what have you, but I think sovereign risk is a real issue that an investor should think about. Where are we? So the Wood Point Gold Project, as I mentioned, in Victoria, great land package, we've picked it up only 2 months ago, with a significant underground mine opportunity, with a functioning shaft and gold processing plant. Alaskan asset, great land package. It's a mix of high-grade silver, zinc, volcanogenic massive sulfide, VMS, as well as gold opportunities. And also, as I mentioned, our Mount Carrington project, gold and silver in northern New South Wales. So across those 3 assets and those 3 commodities, we've got significant metal endowment, almost 700,000 ounces of gold. 76 million ounces of silver is equivalent to 1 million ounces of gold in value. Add them all up, about 3 million ounces of gold. Gold's currently $1,700 US an ounce. So you can get an idea of the sort of the in situ value of the White Rock assets that we hold. Importantly, again, for the investor, not just the jurisdictions and the assets, but who are the people that are running the company? Who are the people that have had the experience? Who are the people that are going to be managing your money? Who are the people that are going to be trying to extract the value of those assets for the benefit of the shareholder? And you can see we've got mining engineers, we've got corporate finance people, we've got business management. So great depth and breadth of experience, both in the mining industry, but also more broadly. And I think it's important that a company has depth and breadth outside of the industry as well. We've also got a fantastic technical management team, accountants, mining engineer, and 2 geologists. Rowan's worked all around the world, and many people may have heard of Quinton Hennig, based in Denver, also a world-renowned geologist, giving us guidance and technical advice. Very briefly, Wood Point Gold Project. You know, why Victoria? It's had a great historical production history. It's going through a second renaissance, thanks to the world-class Fosterville gold mine, run by Kirkland Lake, that many people may have heard of. And we think it's a great place to be, especially in this COVID world, where it can be problematic to run a project in another state of Australia, let alone overseas. We have a great land package. As I said, we only acquired it through a merger 2 months ago, and we'll be unfolding our regional exploration plans for this over the next month or 2. And I think that will show a great opportunity for the investor. Had great past production, over 1 million ounces. There's over 10 historical mines. It's underexplored. It's never had systematic exploration. And we think it's a fantastic opportunity to get boots on the ground and make further discoveries. As I mentioned, it's not similar in rock type to Fosterville. Central Victoria has yielded significant ounces, and we hope to add to that. The acquisition also came with a famous gold mine called Morning Star, producing over 800,000 ounces at almost an ounce a tonne. The shaft goes down 800 metres. It's currently flooded below 10 level, and we're working above 9 level as we speak. We think there's great potential there. It comes with 2 mining leases, and I'll explain a little bit more why we think there's great potential with the mine itself. There's an area called the gap zone. About 500,000 ounces was produced above 10 level. About 300,000 ounces was produced below 14 level. And there's this gap. So only a few weeks ago, we announced the commencement of a large drilling program to test this gap. There's no geological reason that we can see why there isn't ounces in between those two past production areas. And that's a photo on the right of the drill that's just started. But we also only in the last 2 weeks commenced a second drill, drilling from surface to test the areas above 6 level in the Dickinson South area. So very active there, as well as in Alaska, where we've just finished our season mid-September. This is the Alaskan project. As I mentioned, we just closed that season with the onset of winter mid-September. Where are we? Central Alaska, due south of Fairbanks. It's great for polymetallic minerals as well as gold, large land package, and a maiden JORC resource running over 600 grams a tonne silver equivalent. So we're blessed with a geological domain that encompasses both VMS and gold. It sits in the Tintina Gold Belt, very famous, well endowed. So we're right in the heart of that. And there's our land package. So out to the east, to the right, we've got the VMS and the JORC resources. Out to the west, we've also got VMS targets to drill, and we've also got the very large last chance gold deposit, last chance gold. It's not a deposit yet, target for drilling, I should say. My apologies. And then thirdly, our Mount Carrington project, advanced gold and silver, central New South Wales. You literally walk onto ore. It's got gold and silver resources. It's got a mining lease. It's got a tailings dam. That's the photo on the bottom right. It's got a feasibility study. And we're fortunate to have found a joint venture partner to help advance that through the feasibility study to definitive stage, advance the environmental impact statement process, all the while White Rock is free carried. So it allows White Rock to focus on our Alaskan assets. It allows White Rock to focus on our Woods Point Gold Project asset, all the while cornerstone by Mount Carrington being free carried, and allows the White Rock shareholder continual exposure to this gold and silver asset as well. So look, ladies and gentlemen, with that, I thank you very much for your time. You can find more information on our website, and you can also drop us an email if you have any questions. Hope you enjoyed that presentation. I hope you've got interest enough to go and maybe have a look deeper into the opportunity. Thank you.
Welcome to this presentation for Wholesale Investor on the Vault Resources story. My name is Trevor Matthews. I'm the Managing Director, and I'll be running through some key elements of Vault's assets and activities in the graphite and battery anode materials sectors. So Vault's in a great position, I believe, that to become a globally significant graphite producer and battery anode producer also. We're forecasting graphite demand to increase 7 times by 2030, mainly driven by demand for in lithium-ion batteries and the electric vehicle market. We're developing integrated battery anode material supply chains in Europe and the United States. Europe's the #1 EV market in the world. The United States is #3. So these are both significant markets, and Vault plans to be a key part of the opportunity there. So the project's integrated supply chain will be based on 2 mines, one operating that we recently acquired in Zavaleski Graphite in Ukraine, and a large project in Tanzania. So we picked up a lot of experience and skills in Zavaleski, existing supply chain and customer base, and also some operating cash flows as well. Great opportunity for improvements there though, and we see strong facilitation in the battery material supply chain in Europe, and we're members of the European Battery Alliance and European Raw Materials Alliance, which I'll talk about a bit further on. And of course, we have our large Greenfields project in Tanzania, which is in development funding discussions on a stage 1 development, followed by a stage 2 development further down stream once we get stage 1 up and operating. We have three key markets we see our products are suitable for. So these are basically across the whole graphite market opportunity. So spherical graphite in lithium-ion batteries, expandable graphite, which is a coarse material for flame retardant materials and foils and gaskets and various other applications, and then your traditional refractory and metallurgical products. Graphite demand forecast to grow 7-fold by the end of this decade, as I mentioned earlier on, to nearly 6 million tonnes by 2030, driven by demand for battery anode material in lithium-ion batteries. And of course, that's all to do with the EV and electric mobility. And this is ultimately trying to deal with, or part of the global push to reduce carbon emissions through electric mobility to deal with the concerns on climate change and increasing global temperatures. So there's an opportunity to be a key part of the strategies and plans to deal with lowering carbon emissions and lowering global warming. Our overall strategy is to develop two distinct supply chains from Ukraine, based on the existing Zalesky business, which has a large resource and is scalable into much higher levels of production. So that would be supplying battery anode material predominantly into Europe, but potentially some into the US. And then Tanzania, with the ReNu project there being developed to supply not only Europe, but mainly the US, with graphite, again, for battery anode production in the downstream markets and other graphite markets, and some material into China to existing customers that we have. So that's a big picture strategy. And the benefits of the integrated graphite supply chain are numerous. So we can see we can help to mitigate supply disruptions that we're seeing in the market right now due to COVID. Big increases in shipping and transport costs. And of course, in Europe, with Zalesky being right next door to that market, it's able to deal with those issues and take opportunities out of the higher pricing that's crept into graphite pricing because of those transport costs. Manage ESG through the supply chain, no issues around proof of origin. We can prove, right from the mine through to the cell maker what the source and of the material is. Control quality and right across the supply chain. Diversification away from specifically China, who produces 100% of the battery anode material used in lithium-ion batteries at the moment. Control costs and lower carbon emissions. So some pretty significant benefits. That's the addressable market in Europe. Significant growth in cell making, and we plan to be a key supplier to cell makers in Europe through Zalesky, and to a lesser extent with our ReNu project in Africa. EU signed a critical raw materials and battery materials MOU recently with Ukraine. And with our Zalesky business being one of the few operating Ukraine mines supplying the battery materials market, we see this as being a key step forward for Ukraine's participation in the, and therefore Zalesky's participation in the battery supply chain. In addition to the key EU alliances, we think this agreement provides good opportunities for us to build our to access capital and build out our plans in Europe. And in turn, that can help facilitate our African development as well. Our board is experienced in construction and operations. Myself, Jack Fazio, strong skill sets, and we have a CEO who is also strong in project development, project studies with a lot of African experience. So Volt's only a $80+ million market cap at the moment. So compared to our peers, who some are trading at 4 and 5 times that market cap, we see some significant upside opportunities in Volt's share price related to advancing our strategy. And in fact, I think our strategy is in advance and better placed than a lot of our peers. So consequently, I see a lot of upside in our share price and market cap. Our major shareholder is also the chairman of Sinway Kambunga. He's participated in capital raisings in recent years. Sinway is Tanzanian born and has always been a strong advocate of Volt's strategies in graphite graphite and developing our opportunities in Africa, but also the recent move into Europe and the United States. So we have a very good suite of assets, one operating, one mine ready to be developed. We're going to start doing studies and work towards the development of our battery anode production facilities in Europe and the US. We've got an integrated supply chain approach, which is to manage quality, ESG, and reliability and various other attributes of the supply chain that would be attractive to end users and other stakeholders. We have a significant mine in Africa, in Tanzania. It's one of the largest in the world, and it still has exploration upside. But Zavaleski also has the same opportunity to expand. Experienced management team, and as I've said many times before, that at this point, Vault's in the best position it's ever been, and we're looking forward to the future and being part of the global expansion of the graphite supply chain over the course of this decade. Thank you.
Hello, my name's Iggy Tan. I'm the Managing Director of Altech Chemicals. Altech Chemicals is an Australian company, and we're focused on alumina coatings for anode materials for batteries. I want you to refer to the future of lithium-ion batteries, and I guess Tesla is setting the vision for lithium-ion batteries. And in their last battery day, they announced the objective of reducing the cost of battery production, and the announcement of their 4680 battery cells, which is 5 times more energy and 6 times more power. They also announced 3 terawatts of battery capacities around the world. And Elon Musk announced the use of extra silicon in the anodes of their battery. And I will talk about the impact of silicon to lithium batteries and how alumina coating technology will help silicon be incorporated in batteries. Now, in a lithium-ion batteries, the lithium ions go from the cathode to the anode on the first charge. And what a lot of people don't realize, that when you discharge the battery, the lithium ions go back from the anode to the cathode, but 10% of the lithium is left on the anode side and it becomes inactive to the battery. And this is called the first cycle loss capacity. So if you can imagine 10% of your lithium doesn't play any further part in the lithium battery before the customer even gets it, this is fundamentally a problem for the lithium battery industry. And a lot of people have been trying to resolve this issue. So there's a lot of studies that show high purity alumina resolves the first cycle loss. It increases the life of the battery, and it even increases the safety performance of the batteries. Now, this is a typical research that shows, if you can see, the uncoated graphite, and this is a coated graphite. And you can see after 200 cycles, the coated graphite has more energy retention than an uncoated material. I also mentioned the safety performance of batteries. Here's a typical example. On the left-hand side is a non-coated graphite battery, and they use a nail penetration test. And you can see from the picture, the battery catches a light and there's thermal runaway. On the right-hand side is a coated graphite battery, and you can see the temperature only rises to 90 degrees. And you can see from the picture there, the battery virtually stays intact. Now, there are 3 ways to put alumina onto graphite material: the vapor method, the solids method, and the liquid method. The vapor method is an atomic layer deposition. It's very costly and expensive. The solid method is not as efficient, but we use a liquid method. It's the most promising and easiest to commercialize. So we have technology that we can coat the graphite material with a very thin layer of alumina at 2 nanometers. And what it does, it prevents the lithium ions from forming the SEI layer. So it resolves that first cycle loss capacity. And what we expect by doing that is an extension of the life of the battery. So if you can see at the 80% mark, that's generally the life of the battery. If you have more lithium ions to play with, you would expect the extension to the life of the battery. Now, we've completed all the test work in our laboratory, and you can see on the left-hand side, under very intense microscope, a very thin layer of alumina, a very efficient layer to protect the graphite particle. On the right-hand side are typical industry attempts. You can see very thick and irregular layers. Now, we've conducted battery tests, so we've taken the graphite material into coin batteries, and we've seen very positive results, and we're very encouraged about it. Now, let's talk about silicon. Now, silicon has 10 times the capacity of graphite, and it's a very promising anode material. So why isn't silicon in commercial batteries today? Essentially, there are 3 problems. The first problem is that silicon expands 300% and fractures. The next problem is that instead of a first cycle loss of 10% in graphite, silicon attracts 50% of the lithium and makes it inactive. And the third problem is that it is a high fade during the life of the battery. So these are the 3 major challenges to crack the silicon code, which allows increased battery capacity. Now, a very simple example is that today it takes 6 carbon atoms to hold 1 lithium ions, whereas on silicon, it only takes 1 silicon atom to hold 4 lithium ions. So if you look at a battery and you can have some silicon in your battery, you suddenly see the holding capacity of lithium on the anode side. So the potential is enormous. So if you can see graphite there, which is around 372 milliamps per gram, by just adding 10% silicon, it nearly doubles the energy capacity of the battery. If you add 20%, it nearly triples the energy capacity of the battery. So the price is enormous, and everybody has been trying to resolve this silicon material. I mentioned also the high fade. If you don't do something about the silicon and you add it into the battery, it actually reduces the effectiveness of the battery and the life of the battery. As I mentioned, the expansion of the silicon particles, 300% in volume, to the point that it fractures. And this causes delamination in the anode of the battery and swell in the battery. We believe that our alumina coating technology, we are able to coat the silicon and somehow contain the fracturing process of that material. And because we have a layer, it prevents that first cycle loss. We have now successfully completed that in our laboratories. As you can see, the very thin layer of silicon around, alumina around the silicon particle. And all our work has been done in-house in our laboratories in Perth, where we've developed a technology using our alumina coating technology to coat graphite and silicon particles, and then produce coin cell batteries so that we can test the performance of these batteries. So far, the work is very encouraging, the positive results, and our confidence is growing rapidly. So this is what we're after, to be able to coat graphite material and silicon material and put it together as an anode material, potentially increasing the energy capacity of lithium-ion batteries going forward. So what is the implications to the end customer? So if you take a Model 3, it generally goes around 423 kilometers on a first charge. If you can add 10% silicon, it'll go to 680 Ks on a single charge, and up to 30% silicon, it'll go to 1,190 kilometers on the single charge. The implication for the battery maker is that they can give you the same distance, around 500 kilometers, and really reduce the size of the battery, which then reduces the cost of the electric vehicle. We have now commenced a pre-feasibility study for a battery materials coating plant in Saxony in Germany. Essentially, we want to produce 10,000 tons per annum of this graphite silicon battery material. We have an option to purchase a site in Saxony, in the east part of Germany. Saxony is a state where a lot of electric vehicles are being produced. And we're very focused on the European battery story. So it's fair to say that in the past, the story about lithium-ion batteries has been about China, Japan, and Korea. We believe the story about lithium-ion batteries will be about Europe in the next decade. Some 600 gigawatts of battery capacities have been announced for Europe, and all driven by EU regulations, CO2 emission regulations. And as you know, some of the major automakers in Europe have announced all electric by 2025 to 2030. So companies like BMW, Volkswagen, Volvo, Jaguar, Audi have all announced all electric by those dates. So in the future, Europe will play a very important part to the EV industry. As I mentioned, some 600 gigawatts of battery capacity. Companies like CATL, BYD, Northvolt, and so on have all announced battery capacities. So thank you very much for your time.
Hi everyone, I am Steve Bohill from Range International, Managing Director of Range International. Pleased to talk to you today about Repal and Range. Repal Indonesia has been recycling waste plastic into logistics pallets for sale across Southeast Asia and Indonesia. And recently we acquired a business in Cairns where we make fence posts and garden edging for sale across Australia. So we're thrilled about that development. The problem with waste plastic is there's too much of it in the environment. Only 10% of the world's plastic is being recycled. But there are trends to stop this, to drive this down, to drive the recycling rate up, and to stop the waste plastic in the environment with extended producer responsibility, sustainable development goals. Lots of activity in that space. Timber is used for plastic, for pallets. And we believe that's wasteful because most of the forests will not be sustainable, not be sustainably sourced. Repal is definitely helping it to solve this problem and is recycling more waste from the environment every year. We take plastic bags, that's one of the main sources, and we recycle over 5 trillion plastic bags a year. We're very pleased to do this. We take waste from landfills. We also take from packaging companies like Tetra Pak from their recyclers. And in Cairns, we take recycled pellets into the fences and garden walls product. We work with large brands, like you can see. We're thrilled with these companies being on our roster, and we believe that they will start to give us waste and help us with this. We can recycle our waste packaging. So I'm sure companies like these ones will be looking at Repal as a solution for their waste. How do we do it? We use a thing called thermofusion, which is a way of mixing plastics together and then putting these into structurally strong, tested ISO 8611 pallets. So we think this is a great process, allows us flexibility of waste type into a solid product. As I say, we use Tetra Pak. It's one of the plastic types we can reuse. That's a great plastic composite for us. It's got aluminium mixed in it, so it makes a strong material, and it's a lower value cost than the polyethylene product we use. In terms of competition, most pallets across Asia and the world are timber. And these are rotting, they can have nails in them, and it's not very good for humans to be caught up with nails or for the product. And we think with all the timber being used, it's bad for the environment. Virgin plastic pallets are carbon intensive, and our 100% waste plastic pallet is a great solution with a 5 to 10 times longer life than timber pallets, depending on the and a much lower cost over the lifetime of the product, depending on the pallet type. There's over 7 billion pallets in the world in circulation, which is a huge number. All of these need to be, circulated and replaced over time. Logistics is a huge and growing industry, and currently there's a pallet shortage globally. So that's an interesting thing, and a lot of supply chains are stuck. So we are, hopeful that that helps our business across Southeast Asia and Indonesia. As I say, most of the pallets are wood, but I think with the trends of safety, with the trends of automation and longer life, and people looking for more sustainable options, then recycled plastic will become in vogue for pallets, and we are definitely leading that space in Indonesia. Major brands using us. We have, as we said, a lot of major brands we're working with already. We have companies coming to us, talking to us about their waste into pallets, which is great. We have a team of 6 nationals in Indonesia and a salesperson in the Philippines. And in Australia, we are fulfilling our orders to Botanica Lifestyle Resort in Cairns, which is a great long-term contract for us. In summary, our business model is about trying to drive up the sale price per kilo. We're doing that with our new HDX mold. New HDX mold gives us more applications to sell into because it's a different, we're making different sizes. And we'll see our sales price per kilo increase. At the same time, we'll also see our COGS come down in 2022 and this last quarter in Q4 because of volume increases through the addition of friction washing and the new wash plant layout. So we're hopeful that our capacity goes up by over 100% in terms of waste processing, which will drive down a COGS decrease of about 40%. In our business, which we think will be positive towards 2022 as we build our platform for aiming for profitability, through the end of Q2 22. And then we can make more HDX molds, we can add more people in the factory, we can add more volume through the factory. So, overall we are platforming for a good year in 22. Richard Jenkins, ex-Macquarie Bank, has been helping drive our business, drive our growth, drive our funding. Chris Fong in Indonesia is a very strong pair of hands across Indonesia with deep experience and in Asia and corporate life. I've been involved for the last 3 years as MD, and Marcus Goldstein in Indonesia is a fantastic operator on the ground in Surabaya and around Indonesia, being a long-term expat, 25-year expat. In Indonesia. Some notable names we have been working with us on and off for a long time. We before COVID end of 2019, we're pleased to win the Sustainable Business Award, and we hope with the tailwinds of sustainability, we're going to be winning more awards going forward. So thank you very much for your time. Thank you for your interest in Range and Repo.
Good morning. My name is Ian Lusted. I'm the CEO of Australis Oil and Gas. We're an $80 million market cap producer with assets in the US, with substantial development positions there as well. This is a very short presentation, but I plan to cover off a brief description of the team, our history, the background. We'll talk a little about the corporate strategy. We'll obviously talk about the asset. And then at the end, I'll just spend a few minutes talking about the US market and the context relative to the opportunity that we present. So with that, obviously we're a public company. I'll need to just make you aware of these disclaimers. And so to get going in terms of the story, in terms of background, the team's worked together now for about 15 years, and we do have a track record in terms of the unconventional US industry. Our previous company was called Aurora Oil and Gas, and it was a very early entrant to one of the big unconventional plays called the Eagleford. Initially at IPO, we had a market cap of $30 million, and by the time we finished that journey, we exited with a market capitalization of $1.6 billion. We learnt a lot of knowledge gained along the way, and we felt that there was the opportunity to reapply that. So we started Australis, the present company. Not long after that company, Aurora, was sold in 2014. Our business strategy is quite simple. There were two key requirements for the asset. The first was around asset quality, and the second was around achieving a low entry cost. There were then some secondary things we were trying to achieve. Still important. We wanted to avoid exploration risk. We wanted to get an asset and have a position of some size and scale. And we also wanted to have control, particularly around development profiles and pace, which we felt was important. The basic plan was to build a position in our chosen play and then to bring in a partner to help fund the development of it. The journey we went on is that we were actually private for the first 2 years, and that time was spent in data rooms looking at opportunities. Really what we found as we looked at those more established plays, that the cost of entry normally encapsulated most of the upside, and there was never anything that we felt we could transact on. But there was one play called the Tuscaloosa Marine Shale, or TMS for short, that we kept coming back to. It was relatively unloved in the US because there were, across the whole play, there was variable well performance, and the wells were relatively expensive. But as we looked at the raw data, the production data, particularly from a small part of that overall play, it became quite compelling. So we took our initial position in the TMS in 2016, and in 2017 we transacted, taking over from a large company called Encana that had a position in the play. So why did we go into the TMS? Well, really the first thing and the paramount thing is rock quality. Within the well production data from that core area, the wells are as good as any other play in the US, and that certainly caught our attention. We had production history, so we knew what the decline profile looked like. We could be confident about it. Because of that misplaced reputation of the play as a whole, it was also uncompetitive. That meant that it was a low-cost entry. It meant that we were able to get favorable terms, and we were able to build a contiguous acreage, which was obviously important to us. The location of the play means that we're close to infrastructure, which is very important for early developments. And the fact that the play produces a high-quality oil was also important because it was of high value to us. So if we look at the play itself for a few minutes, this is a map. We're on the border here between Mississippi and Louisiana. The light blue areas that you see is the core area we've delineated, and the dark blue areas is the acreage we hold. The small rectangles, you can see are small horizontal wellbores. There's over 90 of them in total, and those in red are ones that we operate. We're the largest acreage holder within the play. We have over 100,000 acres, and that corresponds to 400 net locations to the company, a big inventory of wells. We're the biggest operator, 33 producing wells, and we have interest in another 18 wells that other people operate. We're the largest producer in the play, over 1,000 barrels a day of oil. And it's worth saying that we're self-sufficient in terms of cash flow, positive operating cash flow throughout the last 6 quarters. And it is a big resource. Independent certification, mid-case recoverable estimates sit at 170 million barrels. And that's material for anybody in the US and certainly for a company of our size. Let's talk a little bit about the economics. First of all, the existing production. Our operating costs are on par with other unconventional plays in the US, and that's despite relatively low production rates, so we can't achieve some of the same efficiencies. Because of those operating costs, it means that our netbacks are very strong. And you can see here, even with all the turmoil of 2020, we're able to achieve netbacks of the order of $24 a barrel, and they were industry leading at the time. When we think about the economics of future wells, we have to make an assumption as to what the production profile will be. For that, we're very conservative. We just take the average performance of all the wells that we operate that were drilled back in 2014, so quite some time ago. We drilled a few wells in 2018 as well, and so we take those well costs and we just translate to today's contract costs with some small changes, and that generates the figures you see in the bottom right-hand side of the slide. Bottom line, $75 a barrel. The wells today generate NPVs of over $11 million. And IRRs of 81%. I'll remind you that our existing position has 400 net locations with those sorts of economics. So that's what the asset looks like and what the background economics are. Let's just talk about context in terms of our business strategy. So the US unconventional production is well known, and obviously its growth has had a seismic impact on the global market. You can see here the graph in terms of its growth over the last 15 years or so. Perhaps what's less well understood is that all of that unconventional oil actually comes from 3 plays. 85% of it comes from the Permian, the Bakken, and the Eagle Ford. Also, what's perhaps less well known is that even pre-COVID, production growth in the US was actually slowing down. In fact, if you look closely at the purple and the green on this view graph, you can see that they're actually in decline before COVID. And that's from the Eagle Ford and the Barken. The reason for that is both of those plays are now largely drilled out. They're becoming increasingly mature. And it was really more recently, the only growth in the US was coming from the Permian. Post-COVID, you can see the same thing continuing on this graph. The Eagle Ford and the Barken have continued their decline, and the remaining growth is still coming out of the Permian. In the Permian itself, something else has occurred over the last 18 years. There's been a significant amount of corporate consolidation. What that means is that the remaining quality inventory in that play is now closely held. So when we think about Australis and what we're trying to do, which is find a partner, we find ourselves in a market where opportunities for inventory, if you're a participant in those more mature plays, are very limited, or if you're in the Permian, then it becomes very expensive. In that context, we believe we're one of the last appraised but undeveloped quality oil unconventional plays in the US, and we've got a large controlling position in it. So we're very excited and confident in terms of our ability to find a partner, and we feel that the market is coming towards us. So this is obviously a very short presentation and only gives you a brief overview of who and what we are. But the summary is on the slide. But the key takeaway that I'd like you to bear in mind is that we've got a quality reservoir with real production data that supports that. We've got a very clear strategy that we've been incrementally implementing. And we've got an industry that's now moving towards the point where significant value creation is possible. With that, thank you very much, and I look forward to talking to you in the future.
Hello, Tom Soulsby. I'm Executive Chairman of ReNu Energy. ReNu Energy is an oil and gas company by pedigree. We have 2 PSCs in Indonesia, and we have a green hydrogen strategy for Australia, which is relatively new, and that's what I'm going to focus in today. We're a listed ASX company with a headquarters in Perth. Welcome, everybody. Green hydrogen has been adopted by ReNu over the last 6 months, and we've been doing a lot of work trying to establish where our value add is in that chain. Now, state governments have been driving zero emission goals forward and interest in green hydrogen. And you've noticed that the Australian government's even adopted zero emission goals, but the state governments were months, if not years ahead of the federal government in that regard. I now believe that line can be confident that we can grow through diversification into hydrogen, and we're going to focus in on helping heavy mobility comply with these targets. And post our work we've done with GPA Engineering, we have a greater focus on a hub and spoke model. I'll talk about that in a second. Here's the rollout, and you can see this on our presentation. I won't labor these points, but every state in Australia has embraced a zero emission target by 2050. And for Lion, we've been positioning ourselves for this for some time. We've got a MOU with Wagner's, we've got an MOU with a Chinese equipment supplier, and we've got this relationship that we've got with GPA Engineering as we have been trying to answer the question, what would be the delivered cost of hydrogen to heavy mobility, and where would we be able to add value in that space? And we're already at that juncture. The regulatory environment for heavy mobility is very favourable. To give you an idea, TransLink is the public sector public transport authority for Queensland, and it's informed us that by 2025, they have a zero emission goal for all new vehicles. This is placing pressure on their delivery partners, the fleet operators, to deliver against that goal. So people are rapidly trying to work out not only for vehicle availability, but also how will they fuel that either via electricity through BEV buses or hydrogen into hydrogen fuel cells. Now, New South Wales and Victoria are even more aggressive than the Queensland government and being very specific about these goals, and there's strong competition between states. Why are we focusing on buses? I have to say that hydrogen fuel cells can easily displace and replace diesel buses. And one of the critical aspects is not just the buses being hydrogen fuel cell versus BEV, but the biggest issue is depots. The biggest issue is schedule. So depots can be easily accommodate hydrogen fueling infrastructure, and fleet operators have minimum schedule changes, and the buses themselves have diesel-like refueling times. So whereas in the case of BEV buses, they take 6 to 8 hours to recharge, and they also take a lot of infrastructure and a complete refit out of the depot to be able to accommodate BEV buses. We think hydrogen will over time be the preferred technology for zero emission goals. This gives you a bit of an idea of an aerial shot of 3 Brisbane depots. You can see that the buses are packed in like sardines, and at night they're chock-a-block with buses. And so there's no existing battery electric vehicle recharging points, and it's highly likely that these depots do not have electricity capacity to recharge BEV. The depots and schedules are built around high-speed diesel refueling. And on-site hydrogen refueling infrastructure can closely resemble the existing diesel refueling kit, and it fits into a small footprint in a modular way that would occupy a couple of those bus parking spots. To give you a bit of an idea of the cost of an inner suburban depot, have a look at Sherwood. The Brisbane City Council had to spend $132 million in 2021, or approximately $800,000 per bus parking spot to buy that depot. So if you get to renovate that depot or buy adjacent land for rolling out of BEV infrastructure, it's going to be very, very expensive. Europe's growing greatly in terms of rolling out of their bus network, and it's doubled from 2019 to 2020. It's already being embraced strongly in Europe. And the reason why we want to look at buses, in addition to the state government setting their zero emission targets, there is a whole ream of manufacturers that have appeared over the last 5 or 6 years. And this increasing number of manufacturers means there's an increasing number of vehicles available for consuming the hydrogen, so it's a ready market. This gives you a bit of an idea of refueling infrastructure rolled out by region globally. Asia is now the strongest area for refueling stations, largely driven by China. The EU's been robust as well. This gives you a bit of an idea of the global map. You can see there's quite a number of stations in Europe and China. You can see a lack of stations in Australia. To give you an idea about China, they had 1 station in 2017, they've now got 115. They've got more than 1,000 planned by 2025. The major provider of equipment, refueling equipment, is Senstar. Senstar's our MOU partner. We're well placed to leverage the economies of scale that's been driven in China for rolling out of their refueling infrastructure. And we have a real opportunity to marry that infrastructure with green hydrogen production in Australia, leveraging our renewable resources. Australia's rollout is formative, and Australia can not only lead the world in green hydrogen, but we can also lead the world with the right policies such as zero emission goals and rolled out, and we can marry green hydrogen with refueling infrastructure. And Lion wants to lead the way there and fill that gap. Here's a bit of an idea of a concept refueling station. It's fairly simple. This is one where the hydrogen is produced on site and it's distributed through dispensers at 350 bar into either trucks or buses. As you can see, we can roll it out in trains and we can build it out modularly so we can meet the customer's requirements. This gives you a bit of an idea about a hub and spoke model that we've devised. Depots may not be able to have the space for hydrogen production and refueling. We may just put refueling out in the depot, and this shows you that we can build the hub like I've just shown you, and we can just tubular trail the tubes out to the hub, out to the satellite, and we can refuel at each bus depot. So Lion is already on top of some of the issues at the depots, the infrastructure issues. And we're excited to be deploying this hub and spoke model as 2021 moves to 2022 and 23. So we want to be the first mover in green hydrogen. We want to develop a scalable hub and spoke model. We want to be flexible. We want to be the first hydrogen to customer network provider, and we want to leverage that skills to exploit the back to base model. Thank you for your time today, and we hope that that was some insight. For more information, please refer to the website lionenergy.com.au.
Hello, my name is Greg Watson, and I'm the CEO of ReNu Energy. Thank you to the teams at Peak Asset Management and Wholesale Investor for the opportunity to present today. I'm going to speak about ReNu Energy's strategy, which has been an incubator and accelerator of renewable energy technologies and projects. Firstly, the disclaimer slide. By way of corporate snapshot, ReNu Energy listed on the ASX in 2002 as Geodynamics Limited and rebranded to ReNu Energy in 2016. Our focus is to be a renewable and clean energy incubator and accelerator. We do this by taking strategic stakes in and nurturing renewable energy projects. I will expand on this strategy during the presentation. Our board is comprised of Boyd White as chairman, Tim Schofield as executive director, and Tony Luca as non-executive director. The directors have extensive experience and an accomplished record in the energy sector. At the time of recording, ReNu Energy's market cap is 9.3 million, based on a 7-cent share price. Our September 2021 quarterly activities report shows cash at bank of 1.12 million, with an R&D tax refund of 632,000 due to be received this month. ReNu Energy is debt-free. Despite the increasing focus on emissions reduction and net zero, there is limited exposure for ASX investors to emerging renewable and clean energy technologies and projects. ReNu Energy's strategy gives shareholders exposure to projects and technologies that are sitting in private companies and public unlisted companies. The strategy spreads opportunity and risk across multiple investments. There are several ways ReNu Energy shareholders benefit from this strategy, including asset revaluation as the investments move to commercialisation and generate earnings, supporting investee companies to IPO, selling down or exiting via trade sale, or moving to a controlling interest and consolidating revenue. As we know, there are strong tailwinds in the renewable and clean energy sector. Over 18 billion was invested in large-scale renewable energy projects in 2020, and record equity was raised by clean energy companies in the first half of 2021. As I said before, despite this, there is limited exposure for ASX investors to emerging renewable and clean energy projects and technologies. The board and management of ReNu Energy have made substantial progress over the last 18 months to unlock value for shareholders, including divesting of underperforming bioenergy assets, resetting the company's cost base following a strategic review, addressing the group's geothermal legacy by completing the abandonment of the 2 remaining wells, completing an oversubscribed capital raising for 1.46 million, announcing our renewable and clean energy incubator and accelerator strategy, our maiden investment in June, and a second investment announced in September. We're continuing to pursue additional opportunities, including investments in the green hydrogen and battery technology sectors. The board and management of ReNu Energy have considerable experience and sector expertise to realise this strategy. We've implemented a set of key investment criteria. This involves investing in companies with a large addressable market, a pre-money valuation that allows for ReNu Energy to take a meaningful stake, the option to increase participation, an identified value creation pathway, such as to IPO, to invest in an experienced board and management team with ability for ReNu Energy to fill any experience gaps, protected intellectual property, and importantly, investing at a significant discount to NPV or with the ability to achieve multiples on invested capital. We have developed a structured approach to our investment decision process, as this slide illustrates. ReNu Energy announced its maiden renewable and clean energy investment in June, comprising a strategic stake in Uniflow Power Limited. Uniflow is an unlisted public company commercialising a patented micro-renewable energy generator known as the Cobber. The Cobber is household and workshop scale, renewable, producing combined heat and power on demand from biomass. This multi-fuel generator is designed to produce around 4.5 kilowatts of electrical power and 20 kilowatts thermal energy. By using biomass, the Cobber has the potential to displace fossil fuels in rural and remote settings, in particular diesel and petrol. ReNu Energy announced its second investment in September, which is a $500,000 investment in Enosi Australia Proprietary Limited, providing for a post-money interest of 5.8%. Enosi is an Australian company that has developed PowerTracer. PowerTracer is a leading grid-scale renewable energy trading and tracing solution. It allows organisations and individuals to trace their renewable energy mix 24/7. Through this investment, ReNu Energy gains exposure to a company at the forefront of developing a new class of energy-as-a-service technology. An advanced prototype of the Cobber at the Mugga Mugga Renewable Energy Demonstration Site in Canberra is pictured on this slide. The demonstration of the Cobber later this month in Canberra will enable engagement with potential partners, grant funders, and interested investors. ARENA, for example, has a program specifically established to demonstration of new renewable energy technologies in microgrids. The Cobber has applications in both developed and developing economies. The heat and electricity applications of the Cobber have a role to play in meeting United Nations Sustainable Development Goals, covering clean water, sanitation, and clean energy. Greenhouse emissions balance testing conducted by Uniflow showed the Cobber's carbon dioxide emissions intensity is 90% less than a small diesel generator and 95% less than a small petrol generator. Enosi's PowerTracer allows organisations and individuals to trace the renewable energy mix 24/7. PowerTracer provides full traceability so that consumers can see exactly where the energy is generated. Global green hydrogen markets, for instance, will demand this type of traceability to verify that the hydrogen is produced using 100% renewable electricity. ReNu Energy's investment in Enosi is part of a larger funding round undertaken by the company, which raised a total of 1.5 million. The capital raise was very well supported. Enosi's investors now include Mirvac Ventures, the large clean tech advisory firm Energy Estate, and the Artesian Clean Energy Seed Fund. Recently, Inosi CEO received an invite to attend the COP26 meeting by the co-chair of the UN Energy Committee as a member of the UN Compact for 24/7 carbon-free energy. Inosi has coined the term True Zero. As part of this movement to True Zero, or 24/7 carbon-free energy, the requirement for retailers to let their customers choose, trace, and share renewable energy is starting to gather massive momentum. This is exactly what the Power Tracer platform does. Our first two investments fit our investment criteria, and we are pursuing additional investments to meet this criteria. We are currently in advanced discussions for a third strategic investment, this one in the green hydrogen sector. We are continuing to pursue additional investments, including opportunities in the battery technology sector. Thank you for your time today. The board and management of ReNu Energy believe we have made substantial progress during 2021 in addressing legacy issues, developing an exciting value proposition, and implementing it. We are working hard now to accelerate the acquisition of a compelling portfolio of renewable and clean energy assets. Thank you.
Hi everyone, welcome. Thank you for joining us for today's panel session. We have a great lineup of panelists for you who are going to share their thoughts on the market over the past year and also what to look out for next year in 2022. Now, by way of background, the last couple of years have been a very crazy, dramatic time. The pandemic has impacted, our lives, our communities, our kids, and businesses both big and small. But despite this backdrop of economic turmoil, share markets have recorded some of their biggest gains in history. Since the plunge we saw in March 2020, most markets are now well above their pre-pandemic levels. Our panellists today are going to share their experiences on what was really an exceptional year on the ASX and also look to the forces that are likely to shape 2022. And hopefully along the way, we'll also get a couple of stocks to keep an eye on for next year. So stay tuned. My name is Paul Rayson. I'm the CEO of Hearts and Minds Investments Limited, and I'll be your moderator for today's conversation. But first, let's meet our panellists. I'll ask each of you to give a brief introduction and tell us a bit about your fund or your business, and then we'll move to the questions. First, needing very little introduction, we have Junbei Liu, who is the lead portfolio manager for the Tribeca Alpha Plus Fund. And before I pass to Junbei, I must say that Junbei has been a star speaker at the Hearts and Minds conferences. I think you've spoken 3 times at the conference, and each time it's been a standout stock recommendation. And we're very much looking forward to having you back next year when we go live in Hobart. So welcome, Junbei.
Thank you. Thank you very much, Paul, for such a lovely introduction. And it is such a pleasure to be amongst this panel this morning. And absolutely, I'll be back next year at Hobart at the Hearts and Minds. I'm very much looking forward to have a face-to-face conference. Look, today's panel, thank you so much. Let me talk about a bit about my fund. So I am the lead portfolio manager for Tribeca Alpha Plus, which is a long-short fund that invests across the top Australian companies. So my benchmark towards ASX 200, but I can invest up to, down to very tiny microcap companies, essentially going after where the investment opportunity is. The fund has been around for more than 15, 16 years. And, we have been rated the #1 long short on 3-year level with Mercer. So it's a pleasure to be here this morning.
Thanks, Junbei. Next, we have Rob Gregory, who is the founder and CIO of Glenmore Asset Management. And before I pass to Rob, I'll just say one thing, because I know he'd be too modest to say it, but in the latest Mercer survey to the year to 30 September 2021, if you put aside a geared fund, which came first, Rob's fund came the second highest returning fund in the year to 30 September 2021. So I think a 63% return, Rob, so outstanding. Pass over to you, Rob. Welcome.
Yeah. Thanks, Paul, and thanks for being part of today's conference. So Glenmore Australian Equities Fund, that's it's about 4.5 years old, starting in June 17. The performance has been very strong since inception, up 25% per annum. And really, it's a long-only fund, investing in ASX stocks. It can invest in any market cap, but there's probably a predominant focus on small and mid-cap stocks, and really looking for businesses that have a quality business or a quality service and have the ability to grow earnings significantly over a 3 to 5 year period. And hopefully that growth is not properly factored into the market cap at that point of investment. So that's basically the focus. Really looking for quality business that we can buy and hold over a long period of time.
Thanks, Rob. And also needing very little introduction is Niv Dagan, who's the Executive Director of Peak Asset Management, a boutique investment management and corporate advisory firm, and also a bit of a media presenter too, I think, Niv. Over to you.
I don't know if media presenter, Paul, but thanks for the introduction. So I run Peak Asset Management. We're a boutique investment management corporate advisory business, Melbourne-based. Our whole philosophy is based on co-investment, which means we don't put opportunities in front of investors, and they might be your high net worths all the way to your small cap fund, institutions, family offices, unless we're co-investing and backing it with our own capital. We're sector agnostic, which means we look at any space in any sector, and it's great to be here. So thanks very much.
Thanks, Niv. And we're also very lucky to have Kath Whitaker from SelfWealth, who's representing retail investors today, Kath. So welcome to you.
Thanks very much. So Kath Whitaker, CEO of SelfWealth. We're all about empowering people to achieve financial freedom. As you mentioned, Paul, we've been the advocate for retail investors for almost a decade now. Recently voted the most popular Australian trading platform in Australia by Finder, which is a fantastic award to receive. We're all about looking at what our members trade, building out community, sharing out advice, and of course, providing independent thought leadership and content on trading activities.
Great, welcome. Well, thanks for all joining us again. So let's get into it. Let's talk about 2021 first, and some context, primarily for our fund managers first. And as I said at the top, the pandemic has caused massive personal and economic disruption, and that's disruption in the old sense of the word, which has led to massive fiscal and monetary stimulus, which of course sent markets skyrocketing. The ASX 200's up, I think, over 50% since March 2020. And it also recorded its best one-year return for FY21 of 32%. And, depending on how you measure it, it's been the best one-year return for 28 years, since 1993. And also during the year, there was only one negative month during the whole of FY21, which is quite remarkable. And US markets have done even better. The Nasdaq has doubled since March last year, and it's nearly 60% higher than pre-pandemic levels. So it was a very good year, both for fund managers and for investors. But if you cast your mind back to last year, it wasn't obvious that the market would keep going up. So, as a fund manager and as an investor, it must have been hard to stay invested. So the question really for our fund managers is, how did you navigate the markets over the last year? And what calls did you make to outperform the market? And maybe illustrate with a stock example or two. I'll start with you, Junbei, if that's okay.
Of course. Look, I was just thinking back, oh my goodness, what have we been through? It was absolutely a roller coaster ride. Look, market has gone through a lot, and the strong performance, the incredible performance, really just reflection of the incredible optimism that the equity market and resilience of the equity market was. So when the pandemic first hit, clearly, so when the market was sold off, it's though emotionally it felt like a terrifying time when the market was falling 5-10% a day, and it seems to be nothing to catch it. Now, for most of us, before the government stimulus steps in, it was really a period that none of us have ever experienced, because people pointed to the last pandemic, the proper pandemic was 100 years ago, and many of us didn't quite live through that. So and let alone to see how share market respond in that kind of environment. So that's why the initial initial free fall was really there's no one there to catch it. But what we saw when the free fall took place after a few weeks, what we saw was some of those assets, especially hard asset players such as Sydney Airport, such as Ramsay Healthcare, or the shopping centers, we just saw the value of the hard assets. Now, we don't know if the government, we didn't know the government was going to step in and rescue the world or the interest rate and any of that. All we knew was the hard asset will stand. Regardless of what happens, it will stand. So, and that was the time where we wrote newsletters to our investors, and, we jumped in and invested. We just saw this once in a many decades investment opportunity for some of those most premium and priced assets. What was interesting was there was no one else ready to catch it. So, we pretty much just bought when it kept falling. And then you saw the government stepping up, government doing different things, and interest rate were lowered, there's stimulus and all of that. When that took place, that absolutely builds confidence. Then that's when we know, right, now, not just hard asset, which we bought, we need to start buying some of the businesses that are actually leveraged to, good, high quality businesses that have strong customer franchise, and that is leveraged to a lot of those stimulus. So, there was the retailers, there was, a lot of those businesses that we just saw at very early stage, things will benefit them. And the government, there is someone to support the consumer, and there is someone to support the jobs. It's not really just a abyss that we're looking down. There's nothing to catch it. So by then, I think the confidence was building. This is pretty much around late April, May. We just seeing a lot more confidence. This is 2020. We see more confidence come into the market, and then started supporting those businesses. Now, along that journey, I think constantly as a fund manager, people said to me once, funds management is like climbing a wall of worry. So you always worry about something. And, it's not just buy something, close your eyes, it'll be fine. No, it won't, because you need to know whether the world is moving the right direction, whether the stock price has gone too far. So, there's a lot of to and fro around that journey. Something's gone too high, you sell some, move into the ones that hasn't been perform as well. And they're essentially inching towards, what the ultimate outlook will be, which is a reopening of the economy. I must say this journey has been quite interesting, because that journey, we thought the economy will reopen by the end of last calendar year. All of us have thought, it'll be fine. There'll be no Delta. As long as we got vaccination, everyone's ready to go. But everything takes longer. So we've got all these gyration in the market, and yet moving towards the right way. But it has given us so many buying opportunities for companies. We know in 12-month time we'll be fine, but it just takes time. And, just a lot of buying opportunities along the way that has really provided active managers to really outperform the market, because we can take a longer term view. And then we eventually got there on the basis of, all the government support, cheap money around, keep the consumer working, keep the corporates, keep the jobs. And now that we ended in a place much higher than we were before the pandemic, which is a good outcome.
Yeah, no, there was a lot of stop-start, a lot of uncertainty along the way. So it still required, I think, a lot of courage to stay invested. There's a couple of examples that come to mind, though, that of quality things that were really sold down, that you rode the ride all the way back up.
Yeah, absolutely. So that's the thing. So many times when share price first move, you think, I made 10%, maybe I should take profit. But look, for a lot of quality businesses, you really need to sit there and wait for the ride, wait for your quality companies to generate the return it deserves. So, things like Sydney Airport, it actually took quite a long time before the return came around. Look, we actually thought, the price is actually north of $9, but, with the bid and things, obviously given the times and aviation, it's a fair price. But look, these things, you need to let things play out. You have a price asset. Don't worry about when it will be, because it will get there eventually. Like Treasury Wine, we looked at not so much pandemic. It's more about tariff, trade war, China, and at the time when share price hit $8.30, we just thought, look, it doesn't matter if China's buying it or not. We know it's a brand. We know all these Penfolds will sell, and it will. And if we clear those Penfolds, it will be more than the price it was trading at. So this is when you step in and say, let's buy this. Let's not worry about what will happen to the trade war, because we know it will pass, but in the short term, who knows? And then just buy the assets. And this is how you realize the value for an investor. And then, to work with the market opportunity.
Yeah, I think the treasury price was underpinned by the bottles of grain sitting in the cellar, I think, wasn't it? Rob, I'll turn to you. How was the journey for you? You've had an outstanding year. So, how did you navigate and outperform by so much?
Yeah, look, I think firstly, for any investor, that initial period, a big decision was to hold on to the stocks you own. So I can only speak for myself. I went into COVID with a portfolio of stocks, that companies that I really believed in, and I believed in the earnings rolling out over the next 3 to 5 years. So, in a lot of instances, the hard decision was actually to hold on to businesses that you owned, even in the face of stock price falling very significantly in the space of a month. Then I guess you moved into the next period of sort of March, April, where stock price had fallen very significantly, and you had to sort of think about what the earnings impact was going to be. But to be honest, like in a lot of stocks in my portfolio, the stock price fell so significantly that it really got to a point where you only needed to believe in a reasonable earnings recovery over the medium term, and the stock was significantly undervalued. We saw some very significant price falls in a lot of small and mid-cap names, just as people ran for the exits, which was totally understandable, because I went through the GFC, but COVID was a really different sort of a scenario altogether, really, where 2008, 2009, you had significant financial institutions having real financial pressure, whereas COVID was very different. So it was a different scenario, as Junbei said. So that, I guess, we just had reporting season in late Feb. The first thing you do is you speak to as many companies as you can about how they're seeing things. But I think in a lot of instances, investors probably underestimated the ability for companies to keep operating even under that sort of COVID, work from home and type environment where, certainly in some of the mining services, the miners, they could keep going. A lot of businesses like quarry or financial institutions, people just had to start work from home. But in a lot of instances, business could keep going, and the earnings impact didn't end up to be anywhere near as bad as what had been feared in March. In fact, in August, we actually had quite a recent reporting season. In terms of, so firstly, I guess what I did, I held on to a lot of the businesses I was very confident on. I certainly made some selective opportunities investments. So, a few that spring to mind would be Collins Foods, which is a franchisor of KFC outlets, primarily in Australia and New Zealand. So that was a business where the stock price halved, I guess on the basis that people thought, well, we're not really sure what's going to happen to earnings. And probably after sort of a 3 to 6 week period into COVID, you could see that the earnings impact wasn't going to be too bad. In fact, the takeaway part of the business was actually going very strongly. So that's one. AOB Corporation, which sells 4x4 accessories. That's another one that fell very significantly. And I think after 4 to 6 weeks, you could see that business was intact and the valuation was very attractive. Another one that springs to mind, Premier Investments, which is the retail investment company run by Solomon Blue. And again, there's been a whole range of small and mid-cap stocks, same scenario, where the stock price halved, earnings impact wasn't nearly as significant as what had been feared, and you probably had about a 4 to 6 week period to invest before the stock prices started to recover.
Yeah, well, just one that came to mind that I think was I think you had Alliance Aviation or something. Is that what it's called? Yeah.
Yes.
To buy an airline in the middle of the pandemic, I thought was pretty inspired, and it's done amazingly well.
Yeah. Well, in the case of Alliance, it's not actually. It provides services in the aviation sector, but more to sort of mining companies for the fly-in, fly-out type of workers, so that they weren't quite in the same bucket as Emergent or a Qantas. So initially, everyone was just like, I don't know what's going on with this company. COVID would cause some issues, but in fact, COVID was actually quite good for the event. It was a beneficiary because clients wanted more safety for their workers and actually an uptick in their demand. And in fact, I mean, one of the things that played out quite positively for Alliance was the mining sector was actually, after that initial sell-off, was actually quite immune in a lot of ways, particularly over in WA and Queensland to COVID. So so that's one that the stock price fell. I mean, I think for myself, the companies that I had more confidence to invest in during that sell-off were businesses that have been around for a long time. So you had they're established businesses that in a lot of instances I'd seen trade through GFC. So you had one data point, I guess, of seeing how they traded through a period of stress. But look, there was a lot of opportunities out there, that's for sure.
Yeah, no, well done. Outstanding returns. Nev, you advise and co-invest with a lot of small caps, and how did 2021 go for you?
Yeah, look, it was an interesting year. What Dunbay said, and Rob, I do agree with. I mean, buying hard physical assets at undervalued relative to the market. So that's the key. And we saw that in the GFC, and especially these type of companies need to recapitalise their balance sheet. So it did provide investors an opportunity. There was a lot of IPOs and placements at deep discounts relative to their net tangible asset value. So from that perspective, there was a lot of opportunity. I mean, 2021 was an interesting year. I mean, it's all been about the circular economy for us and ethical investing. And I know Kath will probably explain about that further in terms of her alignment with SelfWealth. But look, all about green hydrogen, all about plastics, all about waste to energy, all about the lithium-ion battery. So those type of themes were really paramount for us. And I'll give you an example. We backed a company called Range International. Essentially, they take pallets. There's been, for those at home that are listening, obviously a big issue with the whole supply of pallets made out of timber. The company Range, simply what it does, it takes recycled plastics and converts it into pallets out of plastics and waste, essentially. And they're cheaper, they're stronger, they're more reusable. And look, we backed it at shell value at around that 2.8 mil EV. We did an underwritten rights issue, and now they're up over 150%. Excellent management team, good track record, moving into EBITDA positive. Another business that we backed is a company called Beam Communications. Obviously, with the whole travel economy starting to open up, we did look at that travel sector, and we did speak to the CEOs of J Rides and Apollo Travel, and we thought that travel is going to come back on. Those people that are locked up at home for 12 months or 18 months want to get out. And what Beam does is they're connected to a company called Iridium, which is a $5 billion network, satellite network. Anywhere in the world, you can essentially have remote telecommunications. It's a two-way GPS tracking, weather. It's a fantastic, and look, strong management, strong balance sheet, trading at one-time revenue. If you compare like a Life 360 is trading at $1.88 billion, Beam's trading at 30 million enterprise value. So look, we thought it was undervalued. We approached Michael, the CEO, and he said, look, Michael, what about if we helped you out and did a placement with some options? Did that at 25 cents. The stock's now trading around 55, 60 cents. So it's had a really nice uplift, but we see a lot of upside as the European market open up. They've got launching New Zealand, and they're getting some really strong traction in Australia through Australia Post and Anaconda. So look, I think the big theme is really the circular economy, hydrogen, uranium. We can go into that as well, waste to energy. And I think that's going to be continuing in 2022.
Thanks, Nev. Yeah, Beam have done particularly well. People finally discovered it, I think, and realised how profitable it's going to be. Kath, for you, SelfWealth has had a pretty amazing, well, you've been going for 10 years, I didn't realise that, but pretty amazing year the last year. And I noticed that the number of active traders has increased a lot, and your trade volume has increased a lot. But I also noticed that the value of equities under HIN has increased by a greater amount. So in aggregate, it looks like investors have done well. And I know you don't track individual investors, but do you have some sense of how the average SelfWealth investor fared over FY21?
Yeah, absolutely. So, looking at actually September year on year, as you've pointed out, so active traders number increased by 58,000 people up to now over 107,000 people. But whilst at the same time, although we know, all odds increased by, just over 21% in that September time period, value of assets, we can see increases more like 25%. So it's an absolute true statement to say that SelfWealth members are outperforming what we're seeing, the growth in the All Ords. And when we think about, well, how did our SelfWealth members do that? So, we think in terms of trading behaviours, I think there has been a lot of love out there for indexed ETFs. I think it is an easier way to go about investment decisions, certainly for retail investors. But once you get beyond that, we saw significant trends in terms of, people falling in and out of love of buy now, pay later stocks as, the market became more crowded. Certainly a lot of support given to a few of the big banks that outperformed the rest. As Niv was mentioning, there is a lot of interest out there in terms of circular economy, EV-related stocks, so anything with lithium in it. And, SelfWealth is the first broker in Australia to provide free ESG data to all members. So, there is this real desire out there to do a bit of work from the retail investor point of view. And it's terrific to see the success that our SelfWealth members have had.
No, that's great. No, thanks, Kath. So let's turn to the year ahead, which I think is going to be much harder. So after the exceptional returns of 2021, what does happen next? Since about August, the market sort of drifted sideways to sort of down slightly, and it's really lacking a bit of direction, and there's a fair uncertain outlook. There's a long list of risks and uncertainties ranging from supply side disruption, the spike in inflation we've seen, the timing of monetary tightening, China slowdown, geopolitical risks, and even the re-emergence of COVID. But to narrow the conversation down, let's just bundle up supply side disruption, the spike in inflation, and the risk of tighter monetary policy. Now, one school of thought goes that the recent spike in inflation is driven by temporary factors, government stimulus, pent-up post-pandemic demand, supply-side constraints, labour shortages, border controls, and so on. And the thought goes that this will even out. This will even out over 2022 as supply chains work through the backlog, people get back to work, and globalisation starts working again. And related to this view is that central banks won't raise interest rates too far because it'll stifle the recovery, or probably more importantly, we just can't afford it. The world has too much debt and we can't afford too high interest rates. The other view, though, is that the long decline we've seen in interest rates over 40 years is coming to an end, and that the deflationary forces of globalisation have peaked, and cost increases and localization will start to feed through to costs and wage growth, and inflation quickly get out of control, and central banks make a mistake and increase rates too far, and that really whacks the markets. Now, the answer is probably somewhere in the middle, and I don't know the answer, but probably starting with you, June Bate, how are you thinking about inflation and interest rates, and how's it likely to change the way you manage your portfolio for the year ahead?
Look, absolutely. That's actually a fantastic sum up of what sort of factors and things that as fund managers are thinking about and worry about and reposition their portfolios about. You're absolutely right about the the short-term inflation. Absolutely, these numbers will look very high. Could be alarmingly high, However, most of the central bankers around the world are of the view that this is transitory, and we can point to many reasons of why it is transitory, because of supply chain disruptions, the borders are closed, labors that the labors that used to move around the world are not happening, so businesses can't find people to to service a lot of those roles. So all of that will add to short-term inflation. And it is going to last longer than what most of us previously expected. Many of us expected that to pretty much complete by now. And it looks like we'll be here for the next 6 to 12 months. Now, the good news is, a lot of factors that were driving deflation haven't really gone away. So, the technological advancement and things, so that's still there. Aging demographic hasn't really changed all that much. We did have a baby boom, but that's going to take some time before it comes through as labor. And also the supply chain, the latest US reporting season, the September quarter, we heard large multinationals have talked to some of their, operations and manufacturing in the emerging market and now reopening for business. So, this is just early indications that potentially the supply chain disruption will get better, just very, very slowly. Now, but we do believe some of the issues within pandemic has changed. Pandemic has changed the way we do business. So the supply chain is changing, and that will add to a fixed cost going forward for the long term. So what's really changing is that because of the massive disruption happened across the supply chain, all the business has realized that the old school thinking of just in time, which is about how to lower the cost of making a product and get to consumer and make it only when someone buys it. So that sort of concept won't work anymore going forward, because if one country shuts down, you've got no product, and that is a big problem. So companies are moving from just in time to just in case supply chain, which means you want to always constantly have access to the product should something happen. So most of the businesses, especially the large multi-corporations, are now stress testing their supply chain. They are investing more in their domestic geographies where they supply their customers. So which means they will have small manufacturing producing, say, chips and things, rather than outsource 100%. And they will make sure there's enough warehouse to store some of those inventories, keep more products around, keep more people around, employ more people domestically. So all of that will get to higher costs, but it is good for the local economy where the product is sold. So, with that combined, we do think the cost will go higher, but most of the inflation should go away. Interest rate, yes, it will go higher, but don't be alarmed. Interest rate around the world is at all-time low. And remember, the reason it's at all-time low is because the pandemic support. When pandemic hits, no one knows what's going to happen to consumer, to corporates, to ensure things will go as smoothly as possible with all the pandemic-related disruptions. The governments and central bankers had come out and making sure that there is an emergency. There's as much money as possible for anyone who wants to borrow. Now, these needs to go because we're recovering. We're over the pandemic. We've got enough, enough buffer for the consumer. Australian consumers saved 10% of GDP in the 2021 financial year, and this compared to normally 3 to 4%. And this is on top of they spent everything they could also buying online goods. So we saved a lot of money. There's a lot of buffer. So the interest rate need to return to a more normalized level for the economy to function. So it is going higher, but it is just returned to normal. So all of that together, we think the share market is still pretty good. It will deliver a good return, probably more single-digit return, with good dividend being the big component of it. Banks will pay more, resource company will still pay, and then every other corporates, if they can't buy anything else, they will pay out buyback or dividend. So there's a lot of income coming through in the next 12 months. So that will underpin the share market, aside from the M&A that's going to really spike up every second day. We're reading about it, but that is going to be a feature as well. So, sort of mid to slightly higher single-digit return of the share market, not as fancy as last year, but still very good return compared to where the cash rate is. So, we're sort of in that sanguine positive camp at this point.
Good. I feel better already, Chimeric.
Welcome to my world.
Rob, how are you thinking about inflation, interest rates, and is it going to change the way you manage your portfolio?
Yeah, look. Firstly, not really. I mean, my fund is absolutely bottom-up focused type of fund. There's high quality businesses to invest in. So it doesn't really. We don't really alter the composition of the portfolio based on we think a certain macroeconomic event is going to play out or scenario. But having said that, I mean, you've got to be focusing on inflation and interest rates for sure right now. I mean, it's I think in terms of inflation, I think a reasonable degree of what we're seeing right now will improve over the next 12 to 24 months, just on the basis that as we come out, as the world comes out of COVID, I think a lot of these supply chain issues and labour constraints can gradually improve. But I think it'll take a while. I think we probably, again, COVID's probably worse in a lot of other countries apart from Australia. So I think it'll take a while, but I think that will resolve itself a bit. I think in terms of interest rates, and this isn't really, I mean, interest rates, regardless of whether you see inflation being permanent or transitory, interest rates are incredibly low relative to the strength of the Australian economy and the global economy. Ridiculously low, really. I mean, a bit like in 2009, where we just saw central banks, they respond to a crisis with very stimulatory monetary policy. And we see exactly the same thing with COVID. So I think, my personal view is I think the central banks really should be looking to raise rates, if not late this year, then in 2022, just on the basis that the global economy is very strong. And I think it distorts too many investment markets to have interest rates as low as they are. But I don't think that should stop investors investing in quality businesses and buying and holding them over that, say, 3 to 5 year period. I don't think that's a showstopper. But I could absolutely see it creating some small corrections or sell-offs from time to time over the next 24 months on that, because that's probably the main issue that most people are focused on, that inflation, bond rates rising. Obviously, I think everyone's aware that there are certain parts of the ASX that are probably susceptible to that, the interest rate sensitive stocks, and certainly some technology stocks which might have earnings that are quite a fair way out into the future. I think they're probably susceptible to a normalisation of interest rates. So, I think from my point of view, you just got to make sure you're really comfortable with the companies you own, make sure that the valuations are reasonable. And I guess the other thing, just with inflation, the one thing we've been quite thorough is going through the portfolio and making sure the companies we own, in terms of are they seeing cost pressures, and if they are, do they have the ability to increase prices, or does this inflationary period have the potential to create some negative earnings impacts? So that's definitely something that we've had a good look at. I mean, I think Domino's had a recent example of that recently. So I think there's some little indicators that you've got to keep an eye on. But as a general comment, it wouldn't derail my generally positive view on this.
No, good. As long as I don't put the price of my margarita up. Kath, a sort of related question, Kath, for you. The low interest rate environment we've had for many years now, and better access has brought a whole new generation of retail investors to the markets, and many of them have probably only seen good markets, good times. So I'm interested in what SelfWealth is doing to position or educate new investors on market cycles and prepare for an eventual change, because it's not always going to be good. So on the education and positioning front, or messaging, what's SelfWealth doing there?
Yeah, absolutely. And it's something that we take very seriously. We consider it a responsibility of ours to think about, helping people understand long-term investment strategies, which can mean, of course, there can be dips in the market. And so, we've been fully committed for quite some time to providing independent education and content on the platform on topics like you've just mentioned, in terms of this can happen, does happen, please be aware of it. However, the mindset being, it is about being in there for the long term, and also about making responsible decisions in terms of, when you are making an investment decision. And look, from a SelfWealth perspective, we anticipate this next year, there'll be some increase in interest rates. However, from a retail investor point of view, you've got to bear in mind a lot of the retail investors are on our platform because they're of a generation where they're seeing the housing market continuing to increase. Number of those people are priced out of that housing market. So they're looking for alternate ways to grow their wealth. So we strongly believe investment in equities will continue to increase and grow in the next year. We, of course, believe that investment in crypto as an asset type will definitely increase in the next year. And, we mentioned the education, and of course, we're very upfront in terms of speculative nature of crypto investments. But it is about presenting, that rounded view of, look, this is the risk, this is the type of asset, and, please be thoughtful of this as you're investing your money into these asset types.
Yeah. If we get time, or we probably won't get time, we won't talk about crypto, but if we get time, we might. Niv, the market, interest rates. I was maybe going to ask you about IPOs. Actually, it's been a hot market. It's been, I think we're heading for a record number this year in terms of IPOs, and I think there's another 30 odd to come between now and Christmas, which is extraordinary. I know the last quarter is always the hot one, but what have you seen? And I actually haven't worked out the market-weighted performance of IPOs, but I think they've done reasonably well this year versus other years. So what are you seeing, ahead in the market, IPOs, and just the environment for new listings?
Yeah, look, there's a lot of money still sitting on the sidelines, and it's been a good 2 years. And I do agree with Junbei and Rob and Kath, it is going to get a lot harder. I mean, interest rates are going to rise. Cash is still king, we feel, and it's going to find, it's all about being stock specific, sector specific. As you mentioned, Paul, it's IPOs. We're expecting 25 to 30 new IPOs to hit the market between now and Christmas. A huge plethora of IPOs coming through the range, which is exciting. I think investors really need to go and have a look at the capital structures. I think that's important. I think it's important to know how much money's been raised in the seed capital raise relative to IPO. Does management have skin in the game, or have they literally just plucked some of these assets, done some pegging on the ground for $10,000, $20,000, $30,000 and wanting to value it for $500,000 or $1 million? So I think, look, some of the valuations are the key. Smart money will follow smart money. So once again, for those investors that are listening at home, it comes down to backing successful track record of management, and what have they done in the past and what are they doing in the future. So I think, look, we're seeing a lot of resource IPOs, Paul. We're seeing a lot of, in the whole circular economy space, as I mentioned, green hydrogen's a big theme, uranium's a big theme, ESG investment's a big theme. So look, I think that's going to continue. But it is, I do agree with Junbei and Rob, what they are seeing, and yourself, it is going to be a much, much trickier year for 2022. But the only tip that I can give investors listening is just being stock specific, sector specific, and follow the smart money. That's the key.
Yeah, well, that's good advice. We'll stay on that theme though. So, the prevailing trends are going to be hard to work out, but you can look at sectors and stocks that look attractive given what we have ahead of us. So, getting to the pointy end of what our listeners are probably after, Junbei, can you point to some sectors or stocks that you really think are attractive through to next year?
Yeah, sure. Look, I am similar to what Niv said, and also Glenn said as well. I do believe so this year, because things are going to get trickier. It's actually not about just buying a sector. It's about buying the company within the sector. And obviously, because we're a long short fund, we can play long and against short. But we just find if you can actually find the company, doesn't matter what sector it is, and it actually best when nobody else likes it, that sector, you will generate the best amount of return. Now, I think before, let me point to a few names. Some of them may be very expensive companies. Some of them are cheaper companies. And I think if you get the right company, it doesn't matter what it is, it will do well. Overall market may be flat, but they will do well. So first of all, first one we really like is Seek. Now, Seek has performed quite well, but has lagged some of the growth companies. It previously, it always looked expensive, but now this is a company, after the restructure, this is a company that offers majority of the earnings as a domestic job board, and it has been, so strong in that positioning. It has a revenue significantly, over the last 15 years, it's been around, even though it's a mature market. And we think just for that domestic business, they will be very leveraged to the upswing of what's happening in the job market here in Australia. Companies can't find enough people, and the churn is still not as high because people are not leaving their jobs, and then there's just heaps of roles that just can't be filled. So SEEK is well leveraged to that. You will be able to get double-digit growth in terms of revenue for just the domestic business. And then we think a lot of the investment into early stage Asian, Southeast Asian business will do well, will just start to generate return. And also SEEK, buying SEEK today, it gives you that exposure into the new venture, the early stage growth company venture that you can have exposure to. You know, I must say SEEK's management that runs that business, are probably one of the best that is in and best track record in finding the early stage business to partner with. So certainly that is a company. It looks expensive when you back out a lot of those losses and things. It's not any more than some of its peers, and it does offer you very solid growth, and it makes money. You know, a lot of time when you look at those growth companies, they don't make money, and that's the area where you do need to be careful of, because valuation is too high for business, doesn't make positive cash flow. SEEK generates good return and exposure into all these high growth areas, and we do think that's a really interesting space. Now, another one I heard Glenn mention earlier on. Okay, it was an expensive business. It became a whole lot cheaper recently. And, this is a little bit counter consensus. That's Domino's. It's, look, we know. So, sometimes when investors invest, they tend to go top down. They're going, stay at home winners. Let's not buy them, sell them all. Don't worry about it. Let's worry about it in a couple of years' time and buy the, reopening thematic. Whilst it works, but we do find this is the time where you actually pick up those stay at home winners, sort of cheaply, simply because, at this point, no one wants to price in 2 years' time what the earning might look like. We think this business has been sold off very unfairly recently, and we think it has a lot in its business that will offer structural growth, not just cyclical growth like many other sectors. Once the reopening economy completes in 12-month time, many of those mature businesses will struggle for growth, and companies like SEEK, like Domino, will give you much needed growth for your portfolio. You need a portfolio that's been future-proofed, whether you're in green energy or others, or structural leaders. You just got to have those businesses in your portfolio to benefit to the upside. Now I can go to a whole long list. Do I have time, or should I start and leave others for
we might come back, but Rob, you might, besides Domino's, have you got a couple of names that look interesting for next year?
Yeah, sure. Look, there's two stock. Firstly, one that springs to mind would be MA Financial, previously known as Moelis Australia. So that's the business listed in 2017. A bit like Macquarie Group, started off corporate advisory. They've got a very strong expertise in corporate restructuring and helping businesses emerge from financial difficulty. And they gradually transitioned that into asset management, and that's really now the driver of the business. Asset management makes up about 70-75% of group profit, and that's not. They do have an equities business, but they're probably bigger in the asset management parts of property and credit and hospitality assets. So, creating investment products for in a lot of cases high net worth. They are moving into targeting retail investors as well, but they've really targeted some specific niches in asset management where they've typically had historic knowledge and expertise from their corporate advisory arm, and created some products that they can see demand in the market. So that's a business that has very good management, very aligned. Senior management have significant holdings in the business, and I think they've got a really good platform for continued AUM growth. And so they were sold off very dramatically in the COVID period of March last year, but they've really emerged very strongly to it. And I think that's given they'd only listed in 17, that I think having seen trade through this last 18 months has given investors a good feeling of confidence that they can navigate challenging trading conditions. And I think they've just got a really good platform. As we all know, when Australian funds management businesses get it right and have a good platform for growth and have good product to take to they're very scalable, and I think MA Financial definitely has all the attributes. Some of the success stories we've seen on the ASX. So that'd be one. The other one that springs to mind, Premier Investments, which is a retail investment company. Obviously, everyone will know Solomon Lew, who's the chairman of that business, is a very significant shareholder, and that owns a number of retail brands. And as an investment in Breville, which has been incredibly successful. Mark McGuinness, who was the previous CEO, he left a few months ago and has been replaced by Richard Murray from JB Hi-Fi. So a very strong management team. They've got a number of very good brands. Probably the two that I'd call out that have particular scope for earnings growth coming out of COVID would be Peter Alexander, the premium sleepwear brand, and Smiggle, which is sells stationery and that kind of product to school kids. So Smiggle, his earnings have been impacted by lockdowns around the world. It's a genuine global brand, and I think that can perform really strongly coming out of COVID. And the other thing to call out with Premier is that they've got their own 100% owned company-owned distribution centre in Melbourne, and they're particularly well placed as the retail shoppers move increasingly online. So that's something that they benefited from during COVID. More people buying product online, which tends to be less discounted and high margin for the retailer. And I think over the next 3 to 5 years, there's a lot more upside in terms of Premier doing more business online, which has great impact for margins for them. So that'd be two that spring to mind. But I think there's definitely a number of stocks out there that are interesting right now.
Yeah, no, thanks, Rob. I hope they're paying rent again now. Niv, a couple of names. No pressure.
Yeah, I mean, one stock that we backed only a few weeks ago, we undertook a placement at 2.5 cents with a 1-for-2 options. A company called Latrobe Magnesium, stock code is LMG. And what's happening there, for those at home, there's a huge shortage in magnesium with what's happening with the whole lithium-ion battery space and automakers. So done exceptionally well. China just come out and saying they're disrupting the whole supply chain. Companies these days are looking for other sources of magnesium outside of China, and they're building a facility in Latrobe Valley in Victoria. So LMG, check that out. But we believe that's going to continue. And that, look, magnesium actually in the whole CO2 space is really interesting in terms of from a carbon emission space. Another company that we've backed recently, and I've been a major shareholder of, and I'm increasing, is a company called Timeless, which is TYM. I mean, carbon credits is something really interesting. What they've developed is they've developed a platform for the tracing and trading and monitoring of green energy units, such as carbon, but also across the board for energy transmission, virtual power plants. We think that's going to be a really big theme for 2022. ReNu Energy just recently raised 200 million at 2 billion. I actually met Mr. Roberts, I think it was Danny Roberts here in the Wholesale Investor event about 18 months ago in Sydney, and he was trying to raise money. Then he goes out and raises 200 million and 2 billion and listing on the NASDAQ. They've just picked up one of the ex-directors or ex-CEOs of ReNu Energy to join the board. So look, Timely is at around that 25, 30 million market cap is really interesting. So they're really the two.
Yeah, no, thanks. And Kath, I was thinking that SelfWealth is now offering, US trading to its investors, which is great, given we're only a very small market here. And this obviously helps with diversification. But do you know, how's the take-up been for individual US stocks rather than just sort of playing it safe and just doing an ETF? Do you know how they're going with individual stocks?
Yeah, absolutely. And so look, we've had conversion rates, 30% of our active traders now have US equities accounts. And as you rightly point out, when we look at the ETF split, if you like, between US equities versus Australian equities, on our US equities platform, very much focused on individual stocks rather than ETFs. So, which to me, there is certainly with certain demographics, particularly the millennials, there is a notion of, buy the stocks that you know. So it is very much a brand awareness piece in terms of, what people choose to buy from a US perspective. But I think, just to kind of add as well to what Niv was saying, we really are seeing a big trend toward, anything with lithium in it, anything related to EV, I think that investors in Australia are getting much more clued on in terms of looking for, what future demand is going to be out there. And, I think they too are also looking very seriously at, overhyped valuations of companies as well. And I think starting to look more at the fundamentals of, when is this revenue growth going to kick in, and hence, the buy now, pay later space has certainly changed its buy-sell dimension as well on our platform.
Yeah, no, thank you. Now, June Bale, I think you were going to mention Alibaba a minute ago, but what I would like to ask you was, what's the current view on China? There's no shortage of risk. There's sort of explicit trade sanctions. There's also implicit ones against Australia. You've got the decarbonisation theme, which is leading to some production controls, which are hurting some of our commodities. Property sector, debt load, shared prosperity policy, which is impacting regulation differently across various industries. So is it an avoid or an opportunity for the brave?
It's always an opportunity for the brave. Look, it's, when you look at some of those changes, from outside, and you look at what's happening in China, and if you haven't followed Chinese market for a long time, it seems terrifying, and it seems, what is happening in that country, it's completely uninvestable. But to take a step back, look at what the government trying to do, and a lot of those policies has been trained for best part of last decade, if not more, has been sort of discussed. There's a lot of discussion paper towards some of those re-regulation of some of those sectors. Now, government's purpose is, in government's view in China, is that the corporates work for the people, and ultimately, if you generate a lot of economic benefit, you need to give it back to the people. Now, in a way, in its core, it's almost like what ESG movement is almost a little bit similar in terms of social, that you give it back to the community where you generate the profit. Now, from China, it's different because it's centralized. So, you work for the people, as in you work for the government. So, there's very explicit rules on, what you should do to generate the overall benefit. And so if you just look at the policy, it's essentially about, doing things more on more social front. So, making the living cost cheaper. So make sure the house prices doesn't rise as crazy as it has been. Making sure that, kids doesn't play, this is a little bit of overstep, kids doesn't play too much computer games, and limit the gaming hours. My kids won't survive. Limit gaming hours, and also at the same time making sure there's fair pay for small individuals, the minimum wage or minimum salary, and reduce the monopolistic power of some of those really large conglomerates, large businesses, which have done very, very well over the years, but it's just need to introduce more competition and sort of, equalize some of the power that they have gathered. So, this is what the government trying to do. And it's just happened that, all sort of took place in the last few months, and seems consecutive of what's happening. Now, there is a discussion that because next year is the 25th year of the People's Congress, it's a very monumental and important year. Now, there is, speculation, or there is possibility that there will be more stimulus. So a lot of bad news are coming through this year. It's because we are getting ready and pave the way for that monumental year that is to come. Very, very significant for Xi Jinping for latter part of next year. So we are definitely expecting, more harmony in the, going forward after this year. And we expect a lot more support for consumer and small businesses, because ultimately government wants to bring, more spending power to the consumer. Remember, they're still very manufacturing oriented economy. For it to get to, its full potential, you really have to get people to spend. You need to give jobs. You need to, stimulate the domestic economy to be self-sufficient. And this is where it's going. So in my view is that it is on its way to become to the next level, to become a more developed and more structured economy. And right now we're sort of going through the midst of it. And perhaps there's a little more to go, but, my view is that if you're a long-term investor for Chinese market, you have to be a long-term investor. You're not in it for a year or two, because these things take a long time to come through. And this is definitely it's for the brave, but we just see so much opportunity for a global investor.
No, thank you. That's a very good insight. Now we're nearing into time, so I just might finish with a personal question, if you don't mind. You feel free not to answer it, but investment management, or even running a big platform, it's a huge responsibility. Managing other people's money is a huge pressure, and in these markets it's even more demanding because you just really don't know. It's tough being an active manager. So the question is more, how do you cope with that responsibility and pressure? But more, what do you do to turn off? How do you relax and take your mind off these crazy markets and this big responsibility? Happy for anyone to go first. Rob, I'm going to choose you.
Okay, sure. Yeah. Look, I think it's a big responsibility managing other people's money. I think the first thing we always make sure we do is know the companies we're invested in very well, and from a people point of view, make sure that the senior management and board that of the companies we're invested in are high quality people. And that's often from seeing their behaviour and the way they treat shareholders over a long period of time. So it's obviously a lot easier to judge companies like Mineral Resources or Alliance Aviation or Premier or ARB, because we've seen the management teams and the boards behave and respond to different scenarios over a long period of time. So, I mean, the first thing is if you hold really good quality business run by good people, that tends to reduce your anxiety levels, I guess, about the stocks you're invested in. I guess from a personal point of view, it's always good to get out and get a bit of exercise and ride and swim and play with golf from time to time and play with the kids. So all those things, like a lot of people, can help you switch off. But I think at the end of the day, if you invest in businesses, that tends to reduce that stress factor.
Yeah, no, good point. Niv, how do you relax?
Every Friday morning, Paul, about 6 of us through COVID went down to Port Melbourne Life Saving Club, and we do a workout, go for a dip, even in the ocean here in Melbourne, which is absolutely freezing if you don't have the nice sun as in Queensland and Bondi. But yeah, look, I think switching off, I think it's hard because it is a 24-hour sport. Because when we wake up, the US-Canadian markets just close. You go into Asia, then it goes to Europe, and it just continues. And it's hard switching off, but I think it's really important. Just the whole work-life balance, exercise, hiking, surrounding your friends, going out. Now that obviously things are opening up, there's going to be a huge push, especially leading to Christmas, to spend some time with family and friends. So look, but it is all about doing your best, and we've got to maintaining a good reputation and ensuring that you only surround yourself with racehorses and those people that are aligned. So no, it's great to be here, guys, and a fantastic panel. So thank you.
Thanks, Niv. And Kath, how do you switch off?
Yeah, sure. I mean, look, SelfWealth, when you combine Australian equities, US equities and cash, we have over $8 billion of asset value on the platform. Being a listed company certainly makes us provide the transparency as we should in terms of managing those funds. So, how I relax is I have 2 amazing kiddies under the age of 9, and I make sure that I spend some fun, quality time with them. And I find that really centers the mind as well in terms of getting that balance right, which is essential for everyone.
Good. And Junpei, how do you take your time off?
Well, I think I'm similar to Kath. I've got 2 young kids, and I actually incorporate, because my job is I manage $1 billion, and it's 24/7, never stops, and share market never ends. So I incorporate my work into my life, and I find ways I work flexibly, and I find ways to incorporate the dinner time, the kids pick up, and all of that. Now, the past reporting season in August was just been incredible. New South Wales was in lockdown, and I was homeschooling 2 young kids while running the $1 billion fund with the reporting season, and we had an amazing time, and the performance was was good, and and my kids were perhaps reading my my reports, and and I have an amazing time. So I think it just work out what works for you, and for me, to relaxation is really find that balance and make it work for me, and integrate them.
Excellent. Well, we're right on time. So thank you to our panelists for joining us and sharing your insights. It was really wonderful. And thank you all for listening out there. We'll put the bios and the details of each of our panelists on a slide after the webcast. So thanks, guys, and enjoy your day.
Thanks very much.
Thank you.
Thanks, guys. Thanks.
Bye, everyone.
Thank you.
Thanks.
Hi, I'm Jennifer Chow, the CEO of Chimeric Therapeutics. I'd like to thank you so much for taking the time to let me introduce and update you on Chimeric today. Chimeric Therapeutics is the ASX leader in cell therapy as the only clinical stage cell therapy company in Australia. Our lead asset, the chlortoxin CAR-T, or CHM1101, is currently in a phase 1 clinical program at the City of Hope Hospital in California. In July of this year, we were pleased to announce the acquisition of our second asset, CHM2101, or our CDH17 CAR-T, that's making rapid progress towards a planned clinical trial in 2022. Our team is continuing to advance our pipeline development with innovative cell therapies, and we're really using and leveraging our expertise and our experience in cell therapy development to move our programs forward rapidly. Chimeric was founded in 2020, and it was listed on the ASX under CHM in January of 2021 with an oversubscribed raise of $35 million. Our current market cap is about $110 million. We have 330 million shares on issue, and approximately 30% of that is board and management owned. Now, Chimeric is focused very much on cell therapy development in cancer. And cell therapy in cancer has brought about a revolution. It's brought about the type of outcomes that you see here, where patients have had their disease be completely eradicated and it hasn't returned. And it's these outcomes that have driven record levels of investment in cell therapy development. In 2020 alone, over $20 billion was invested. And almost all of the pharmaceutical companies, the big pharma companies, have now entered the cell and gene therapy space through either acquisitions or partnerships. And we continue to see record-breaking IPOs for cell therapy companies as they enter. Chimeric, with the most advanced cell therapy pipeline in Australia, has one current phase 1 clinical trial program in glioblastoma. We have 2 additional phase 1 clinical trial programs planned for 2022, and that will take us importantly across 7 different disease areas. So we'll be able to address patients with cancer in 7 different disease areas. Our chlortoxin CAR-T, or CHM1101, is the asset that Chimeric was founded on. And it really was designed and studied preclinically in glioblastoma. Glioblastoma is a type of brain cancer, and it's widely considered to be one of the most lethal and difficult to treat types of cancer. Unfortunately, patients with glioblastoma have very poor outcomes. Their expected survival is really only around 12 months, and most patients don't actually survive more than 1 year. So you can see there's an incredible need for new therapies for patients that are diagnosed with glioblastoma. The chlortoxin CAR-T is very unique in that it uses chlortoxin as its tumor targeting domain. And chlortoxin is a peptide that's derived from deathstalker scorpion venom. It uses this to target the glioblastoma cells in patients. And what we were able to see preclinically is that the chlortoxin CAR-T is able to find those glioblastoma cells, bind to them, and then kill them better than assets that use other immunotherapy targets. Chimeric is very pleased to hold an exclusive license to the chlortoxin CAR-T, and this CAR-T has robust IP through to 2036. Our chlorotoxin CAR-T, as I mentioned, is currently in a phase 1 clinical trial in California. That clinical trial has 4 different dose levels that you see here on the screen, and we're trying to recruit between 18 and 36 patients over what's expected to be 24 months. We were pleased in April to be able to announce that we had completed the dosing of the very first dose level, where we were giving patients 44 million cells through 1 route of administration. We've moved on to dosing patients in the second dose level that you see highlighted in orange, where we're now giving patients 88 million cells, and we're administering those cells 2 different ways. Right into the tumor through a catheter that's placed in a patient's brain, and then also interventricular. As we complete this particular dose level and move up to dose level 3 and 4, we'll continue to increase the number of cells we're giving patients. Next would be 220 million cells. And then dose level 4, we'll see 440 million cells, which is 10 times what we started with. And we'll continue to give patients those cells both through the catheter that's placed intratumorally and one that's placed interventricular. In a couple weeks, in mid-November, we're expecting to see our first clinical data on that initial dose level 1 set of patients. Now, what we've really been focused on is moving everything forward and accelerating our clinical development. For us to be able to do that, we filed and were able to receive FDA clearance for a Chimeric IND in August of this year. What that's going to allow us to do in our glioblastoma trial is go from the current single site trial that we have right now to a multi-site trial in 2022. So we'll be looking to expand out to 2 additional sites to be able to accelerate that clinical trial. We've also been focusing this year on solid tumors and generating all of the preclinical evidence to move into other solid tumors like metastatic melanoma. And in 2022, we plan to be able to advance that program to the clinic and begin a phase 1 clinical trial in other solid tumors with chlorotoxin. Our second asset, CHM2101, or our CDH17 CAR-T, has shown great promise for patients with gastrointestinal cancers. We licensed this asset in July from the University of Pennsylvania, which is a world-renowned cell therapy center. And what we saw with the CDH17 CAR-T is incredible preclinical efficacy. In neuroendocrine tumors, we saw complete tumor eradication with no relapse at all. So we're very excited to move this asset to clinic. We currently have a clinical trial planned to open in 2022 in 4 different disease areas at the same time: neuroendocrine tumors, colorectal cancer, gastric cancer, and pancreatic cancer. We were pleased to recently announce that we've actually been able to achieve a critical first milestone on our path to clinical manufacturing readiness in 2022, the release of our research plasmids. Dr. Wah, who invented the CDH17 CAR-T at the University of Pennsylvania, and his team are currently advancing all of the preclinical validation necessary to move us into that phase 1 clinical trial in 2022, which we will start at the University of Pennsylvania with expansion to additional sites afterwards. I mentioned at the very beginning the cell therapy team that works at Chimeric. Our management team is made up of people with deep experience and expertise in cell therapy. We've been part of over 25 development programs in cell therapy, and we've worked on 4 out of the 5 currently approved CAR-T therapies in the United States. And this expertise really helps us enable rapid development and commercialization. Highlights of Chimeric. We are the leader in cell therapy with the most advanced pipeline in Australia today. We have 2 novel assets, both from world-renowned institutions, City of Hope Cancer Center in California and the University of Pennsylvania. Chlorotoxin CAR-T, our lead program, is currently in a phase 1 clinical trial with a second clinical trial planned for 2022 in other solid tumors. Our CDH17 CAR-T has a broad plan in 2022 for a phase 1 clinical trial. We have attractive near-term opportunities to strategically further develop our pipeline and an industry-leading management team with extensive experience in this area. We see potential value realization pathways. There's 3 different ones that are easy to highlight: a potential sale of the company, strategic partnership, or that we continue to develop independently. We're going to focus all of our time and energy moving forward now on our pipeline, our programs, and our people. I thank you so much for your time, and I look forward to giving you further updates as we continue to develop at Chimeric.
Hi, I'm Chris Noon, CEO of Carly Holdings Limited. Carly Holdings is innovating in the emerging car subscription market in Australia. We count some of the largest players in the automotive market in New Zealand and Australia on our register. We have over 10 years experience operating in the automotive industry in Australia and come to this new market opportunity with our own technology platform and extensive industry partnerships. Our research shows that 38% of Australians would consider car subscription as an alternative to purchasing or leasing a vehicle. We've also seen that car subscription is growing strongly during the COVID lockdowns. A car subscription is a vehicle that's available to you for exclusive use for 30 days or more. The simple monthly payment includes registration, insurance, maintenance, and roadside assistance. There are no break fees, no upfront deposits. It's a minimum 30-day term and 30 days notice to cancel. There's also the opportunity to switch the car to another vehicle if your circumstances change. Most importantly, it's not a long-term financial commitment or debt. Car subscription fits in a big gap in the car rental market. We have car rental for 1 to 14 days, and then we have outright purchase and long-term finance of 1 year or more. The average retention period for a Carly car subscription is 5.8 months. It shows that there's a big opportunity for customers for whom car rental and purchase and finance don't meet their needs. We count some of the biggest players in the market as our existing partners, from Uber, SG Fleet, Turners Automotive, RACV, Hyundai, Suttons Group, and also Alto Group. We've worked with manufacturers, dealers, and also leasing companies. All of these companies see the advantages that Carly can bring to their business, and they see the value of a partnership. Carly, as I mentioned, has a number of major shareholders on the register. We've recently completed a capital raise in April of this year. We carry no debt, and also are anticipating further funds to be invested after approval at the AGM in November this year. Carly is picking up on some global changes in the automotive industry. There is the general shift from car ownership to car access. People are increasingly interested in having access to the right car at the right time, and when their circumstances change, being able to access a different type of car. There's also the general rise in people utilising subscription services for music, for movies, for food, for razors, many different things. People are now using subscription services, and car subscription is certainly one of those. There's also the electric vehicle opportunity. As people move into these new technologies, they have a number of questions around range, battery life, depreciation, and also charging infrastructure. And subscription gives both people and businesses the opportunity to try before you buy and experience electric vehicles in a real life situation. There's also the uptake of multiple mobility solutions. People are using rideshare, rental, walking, public transport, finance, and also subscription to meet a variety of different mobility needs. It's no longer buy a car and keep it for 5 or 10 years. Carly is a totally online proposition. Customers and businesses can view our website, choose the exact car they would like to subscribe to, provide their payment and verification details, and the car is usually in their hands within 24 to 48 hours. Carly operates as a two-sided marketplace. On one side, we have supply provided by automotive manufacturers, dealers, fleet management companies, corporate fleets, and other strategic partners. And most recently, we've started providing our own vehicles into the marketplace as well. On the demand side, we have a range of different consumers right across the age and demographic categories. And also we have a big opportunity providing vehicles to business and government. There is a very large potential for car subscription. A recent study shows that car subscription will hit $80 billion globally by 2030, an annual growth rate of 14%. Our research shows that 38% of Australians are interested in car subscription. In the US, research shows that 59% probably would or definitely would be interested in car subscription. And another forecast shows that 10% of all new vehicle sales in the US and Europe could be via car subscription by 25-26. If we apply some of those metrics to the Australian market, the market for new and used car sales in Australia last year was valued at around $55 billion. If we say that subscription is 1% of that, that's a $550 million market. At 5%, it's a $2.75 billion market. So there is certainly a very large potential for car subscription. Carly has been going very well despite extended lockdowns over the last 2 years. In the most recent quarter, Sydney was locked down for 100% of the quarter, and Melbourne was locked down for 76% of the quarter. Despite that, and despite major mobility restrictions, we saw a 12% increase in subscription transaction value, a 17% increase in Carly revenue. Our subscription retention period actually increased to 5.8 months. And we started purchasing vehicles to expand our fleet more rapidly during the quarter. And by the end of the quarter, 100% of those vehicles were subscribed on the road with our customers. So our growth has been quite strong since our launch in March 2019. We have had some setbacks with COVID lockdowns, but we've bounced back strongly after those lockdowns. And we've also grown revenue during the lockdowns as well. So we've proven the car subscription model works well, both in difficult conditions and also in economically buoyant conditions as well. There are many different opportunities for car subscription that are becoming apparent. This is where customers may have a new vehicle on order, that there may be delivery delays, and subscription provides a short-term alternative. It could be that used vehicle is currently too expensive because of the supplier restrictions. Could be of end of lease opportunity as well, once again, where the customer's experiencing delivery delays. Carly also fits very well into a portfolio that's focused on ESG. Subscription increases the utilization of vehicles. No longer do corporate fleets have to have multiple vehicles lying around waiting for a future use. They can upsize and downsize their fleet at short notice, depending on the demand that's available. We can also provide access to electric vehicles, so people and companies control those vehicles. We could also provide low emission vehicles. Most of the vehicles in the Carly fleet are under 3 years old and meet the low emission standards. Research shows that there's a lot of interest in car subscription. 38% of Australians would be interested, and 47% of people with children would be interested. As we move down through the age groups, 69% of Gen Z and 50% of millennials are interested in subscription, which shows that in the future, demand for a subscription should increase even more. We're also the only company to have secured an ATO product ruling defining the tax benefits and the treatment for fringe benefits tax for car subscription. This is exclusive to Carly, and no other car subscription company can rely upon this ATO product ruling. I would urge you to consider investment in Carly Holdings. Consumers and businesses have shown they're ready for car subscription. The automotive industry is also ready. They know that they need to evolve to survive in the changing market. Car subscription is gaining traction. We've shown that with our results, and we can see that results of other companies around the world. Carly is also well placed to win. We have over 10 years experience in a similar market, our own technology platform, and extensive industry partnerships. Thank you for your interest in Carly Holdings.
Good morning, everybody. Today I'll be presenting on Netccentric Limited, Asia's pioneering digital growth ecosystem. Netccentric Limited is a pioneer and established provider of social media influencer marketing solutions, rapidly commercializing an innovative social commerce platform. We have end-to-end expertise spanning influencer marketing, social media marketing, performance marketing, video and content creation, as well as social commerce. We use data and insights to grow our diversified revenue streams. Today, we have more than 300 clients with over 15,000 influencers across 4 offices and 102 employees within the group. We're EBITDA profitable year to date, and we have a fast-growing business providing our diverse client base with result-focused growth strategies. Over the last 14 years, we've built a diverse range of blue-chip customers, everybody from Milo to Pepsi to Unilever to P&G actually use our services to actually engage influencers across Southeast Asia. We're building a comprehensive platform to serve a large market. The global influencer marketing platform market is actually expected to grow from 6 billion last year in 2020 to 24 billion by 2025, with Asia Pacific set to lead in that growth. We provide influencers with a range of services from branded campaigns where we link our clients to influencers. We help influencers basically sell products via live commerce. We help influencers set up their own merchandise store. We help influencers promote themselves and even engage in CSR activities. What we do is we're actually building a dashboard now so that influencers can log in the morning, see the activities that they can perform to earn money, and at the end of the day, actually see how much they've earned for that day or that month. We're building Southeast Asia's largest influencer marketing platform. Today, we have a dominant influencer network leadership position in Malaysia. All the large agencies from IPG Media Brands, Group M, OMG, Dentsu actually use us, and we are their preferred influencer marketing partner. From there, we currently operate in 2 markets. We are looking at actually expanding from the current 2 markets to 4 to 6 markets over the next 1 to 2 years, either via acquisitions or organically. We've actually identified a number of acquisition targets, businesses similar to us that we believe we can basically acquire to expand our presence regionally. With that, we'll also be building a centralized technology platform combined with the dashboard, as I mentioned earlier, that'll incorporate the data and insights of influencers to actually enable our clients to actually access influencers more easily and in a more automated manner. We're also looking at rolling out social commerce features, which I'll talk about later, as well as fintech capabilities, where we're actually looking at issuing a prepaid card to our influencers so that we don't only earn a cut from their income, but also from their expenditure. With that, we believe that within the next 24 months, we'll actually be able to build Southeast Asia's largest pan-region influencer marketing platform. And that will enable us to basically get regional engagements with leading global brands such as Unilever and P&G and become their go-to influencer marketing partner across Southeast Asia. In terms of our financial highlights, our revenue actually grew 51% year on year for the 3rd quarter to 3.18 million for the 3rd quarter. If you look at the chart in the slide, you'll see that we actually grew quite substantially, and based on the current run rate, we'll comfortably be able to have more than $10 million of revenue by the end of this year. Our quarterly EBITDA actually grew 58% in line with that. We have reached a certain amount of scale, and with that, we believe that our EBITDA will continue to grow as our revenue grows as well. We do have a very healthy balance sheet. We've got more than $5 million in the bank and a proven strategy to deliver end-to-end growth solutions. With that, we are quite comfortable and are able to actually use or leverage on our balance sheet, which is debt-free, to actually execute acquisitions as we move forward. In terms of operational breakdown, our influencer marketing platform, Nafnang, is our core business, contributes 56% of our revenue. Nafnang Live Commerce, the new business that we just started to actually expand into the social commerce industry. I'll talk a bit more about that later. We see that as our future growth driver. We actually partnered with Dentsu, one of the larger agencies here in Asia, and we're partnering with them to basically roll out the live commerce platform to their clients. Our performance marketing agency that caters mainly for e-commerce clients also grew quite substantially. It actually more than doubled its revenue in the third quarter, and we expect that we'll also be able to grow with the growth of e-commerce in the region. Southeast Asia is actually one of the fastest growing digital economies in the world, and e-commerce is one of the fastest growing sectors within the Southeast Asian digital economy. In terms of Nafnang Live Commerce, this is a live commerce platform. So people in Asia have started a trend to actually sell products via Facebook Live. So people actually buy cakes, buy seafood, buy crabs, buy fish over Facebook Live, and brands are starting to engage with that. However, the process of selling products via Facebook is still a very manual, non-automated process. And what we have done is we've actually developed an automation platform that enables people to basically process an order all the way from actually watching live on Facebook. If you want to buy one item, they can private message the seller by clicking +1. If you want to buy 2 items, +2. And immediately that basically links to our payment system to actually process their payment via Facebook or over Facebook, and also then enables the merchant to pick, pack, and deliver the product, all linked to our warehouse where our products are stored to basically deliver the product. We expect live commerce to grow exponentially. In China, which leads in this trend, live commerce actually is a multi-billion-dollar industry, and we expect that growth to also move towards Southeast Asia. In terms of recent progress, our GMV actually grew 288% for live commerce. We actually have a partnership with eShop Live, one of the largest social commerce platforms, which we have a strategic partnership with. We invested in them, and they use our platform exclusively. eShop Live went live on live commerce in August this year, a couple of months ago. And today we have more than 300 products from 200 merchant brands that actually sell on eShop Live. We also partnered with Aeon to actually sell mooncakes in the recent Mooncake Festival. And we see more partnerships, more long-term partnerships with these large brands to enable them to leverage on influencers to actually sell products via Facebook Live, via live commerce, right? Our strategic outlook, we see ourselves being able to continue to expand with the fast-growing social commerce industry. We see scalability through automation. We've actually been investing in technology to automate our platform. And also we see growth through potential acquisitions. We believe that we'll be able to become the leading Southeast Asian influencer marketing platform with the various platforms and services that we provide to our clients. So in terms of investment highlights, we're EBITDA profitable. We have a fast-growing business and operate within a very fast-growing industry. We have a complete business growth ecosystem that provides end-to-end solutions from effective go-to-market right down to generating revenue. We have first mover advantage and barrier entry that's secured through our large social media influencer community that's been built over the last 13 years. And we have a good regional expansion strategy, a strong regional expansion strategy that will enable us to basically expand throughout Southeast Asia. We're trusted by established brands and leading agencies, led by myself, a serial entrepreneur who actually created or crafted the vision for us to grow regionally and expand into the live commerce platform with an experienced board supported by a management team that has a proven track record. Our new investments into automation and social commerce are also expected to offer potential to deliver scalable growth. Thank you.
Hello, my name is Ted Pretty. I'm the Executive Chairman of Cipherpoint Limited. Our ASX ticker is CPT, and I'm pleased to present an overview of our company and to suggest why it represents a really sound investment option in the marketplace today. So what is Cipherpoint? Well, Cipherpoint is an ASX-listed cybersecurity business. It started life focusing on data security software, but has since migrated to providing managed security services to enterprise and government customers. Our focus now is building on sustainable recurring revenues, and we also intend to grow by acquisition. Our Q2 revenue, as reported in our 4C, was around $1 million. We had significant cash on hand, and noticeably, we trade at a significant discount to our listed peers. FY21 has been an interesting year. It was one of transformation where we raised additional capital to strengthen the balance sheet. We developed our focus on a services strategy and recurring revenue model. And in early FY22 acquired Brace 168, which was a cybersecurity platform providing such services. We had a record Q2 and a strong pipeline has been developed for future sales. And we've completed a small bolt-on acquisition. In addition, we've announced some new enterprise customer wins. So what is our core business? Our core business is managed security services, which provides what we call managed detection and response services to medium customers. In other words, we monitor their cybersecurity position across all of their networks and systems to ensure, in effect, they're not hacked or compromised. And we invest a lot of money in platform development and capability and in securing the appropriate accreditations that give customers the confidence that we actually know what we're doing, which we do. Our Security Operations Centre is always on, and we're always focused on continuous improvement and respecting the things that matter to our customers, like data sovereignty. In other words, data remaining in the countries which it should remain in compliance with local laws. We do have our systems hosted in a number of countries, and the reason for that is many of our customers do trade beyond Australian borders. Cybersecurity is a high growth market, so we're positioned well inside that market. And although the market research says that the overall market is growing at 8 to 9% CAGR, we are growing much faster than that based upon the cybersecurity trends that are relevant today around operational resilience, cost efficiency, automation, and reporting. Where we sit in the Australian landscape is also very important to understand. In addition to all of the usual IT&T players and some other specialist cyber players in addition to ourselves, we sit prominently as someone that is an emerging cybersecurity player. What does our business look like going forward? Well, following acquisitions, we are investing in people and we're acquiring new platforms and systems. We're improving our processes and we'll seek to automate a number of our processes so that we can provide cost-effective services to the smaller, medium and business end of the marketplace. So we are certainly focused on building that capability to meet the sales opportunities we have in our pipeline and associated and ongoing market demand. So why invest in us? Well, we say we're a pure cyber play. We've got a scalable and unique platform. We've got a great team with great people. We're attracting the recurring revenue contracts. We've got some good core enterprise clients, and we're trading at a discount to our peers. So from an investment proposition, we believe we're the new cyber growth story, and we believe the market will respond well to that story as we continue to execute on our strategy. Thank you for your attention and look forward to further investor inquiry regarding the Cipherpoint business.
Hello, everyone. My name is Ken. I'm the co-founder and CEO of 8V Holding Limited. Very happy to be here to be sharing about our company and what happened over the last 6 months. Okay, as the company is listed on ASX, stock symbol, stock code 8VI. Now, important, this presentation is not a recommendation to buy and sell any of the stocks. Please get your advice from your financial planners if you intend to actually invest. Our company, in a nutshell, is just imagine Bloomberg, Facebook, Instagram, okay, all integrated into one, right? So we are a fin-edutech company. We integrate financial and education technology into one platform, empowering an investor to invest faster, smarter, and easier. Under the holding group, have 3 main business units. The first unit called VFin, which we just set up early this year. Second one is V College, that started 2008. And the third one is our fin-edutech. They have transformed the whole group. Okay, we call it a game changer called V App, where it help actually our customer to make investment decision in a very intelligent and easy way. So our vision and our passion is to empower everyone towards sustainable wealth. Because one of the key things that we realized in Asia Pacific is retirement concern. So a lot of people couldn't actually put their money, work harder for them, and they wanted to plan their retirement to actually have a dignified life. So that's where we come in and actually provide true education and technology to help them to reduce the risk and invest better. So the board of directors consists of 5 members, of which Philip Forrest have been appointed today. Okay, Philip himself is Australian, stayed in Singapore for many years, and used to head some of the big banking group in the Asia region itself. So very happy to we invite Philip Forrest to sit on our board. Philip Forrest is also a council member of an independent director of Singapore itself. So the business overview. So as a main part of the V College, we started 2008, is to spread value investing knowledge to the world. We have offices in Singapore, Malaysia, Taiwan, and Shanghai. Okay, and we support globally to 29 cities using actually now online tool to spread value investing knowledge itself. Now, how do we do that? We create a very entertaining content, okay, where spread across 3 languages, and namely Chinese, English, okay, and Bahasa, which is one of the most dominant language in the Southeast Asia region itself. Then from there, they will sign up, customer will sign up a 2-hour free webinar, and from there they will sign up for a program. Okay, so and our strategy here is like I said, okay, we are very strong in our content creation. We have so far created 300 videos, and with 24 million views. The total view time is about close to, I think, 1 million hours. Yeah, so this content itself help us to actually reduce the marketing cost, okay, and to attract more so-called subscriber, okay, into our platform itself. So now we can see that there's a strong digital transformation, okay. Ever since during COVID, you have actually proved that our strategy worked very well. Okay, in fact, during pre-COVID, in a year, we only can able to attract about 4,700 or close to 5,000 participants for our program. But during COVID, okay, we have scaled up to actually 26,000. And for the first half of actually FY 2022, which is ended in end September, we already actually also increased by 7.1%. So it means that our strategy is working very well for us. So it's very scalable. Okay, increase of productivity. Okay, per employee itself. We have actually incorporated a very strong CRM system with Salesforce that allow us to identify so-called opportunity and lifetime value of our each customer. So the V app, this app created in launched in 2018, have and gained the so-called financial advisor license by the MAS. Okay, in I believe it's 2019 November. Yeah. Okay. So this allow us to help our customer, okay, in the course of learning, or able to actually to understand the information much better, and they are able to screen about more than 40,000 listed companies around the world, over 25 exchanges, to identify a good company to actually to build their portfolio and actually invest in. So we are truly a technology company because, and in fact, currently more than 30% of actually our team members is actually in the area of technology development and R&D. And soon, by the end of this year and next year itself, it will increase to easily about 45% of our headcount, okay, of the whole group itself. So now, number of users for the V-app currently stand at about more than 100,000 is a user. Okay, so we have a very aggressive growth ever since we launched in 2008 for this V-app. It's a game changer for the group itself. And the whole ecosystem go like this. They come in, our customer come in to learn. From there, they use the app to analyze and stay connected as a community itself. This is, of course, in terms of actually the business model, where we charge from the program fee, okay, all the way staying in the community. There's a strong recurring aspect for the business. So financial review, okay, as you can see, we continue to grow in our first half, okay, 17.6 million, okay, revenue grew by 54%. Our EBITDA actually grown from $4.9 million to $6.2 million for the first half. Okay, net profit have grown also to 4.8 million to actually 3.4 million, okay, 41%. So now gross profit margin remain very healthy at 77%, okay, and our operating income margin, right, improved to 28.7%. Once again, it shows our business model is resilient and is growing very well. So unearned revenue actually increased to 11.1 million. Okay, and our operating cash flow itself, okay, because we are investing very aggressively in our technology, okay, and also in our capex to grow our business in the Asia Pac region. Therefore, our operating cash flow came down a bit in the first half, but we have no concern because, okay, we still have free cash flow, okay, and of course last year, based on last year's result, we have operating leverage achieved in FY 2021, and the receipt from customers stay healthy and grew by 40% to 10.2 million. As compared to the previous quarter, as we have no concern because the company have very little debt, very little borrowing, okay, and yet majority are in cash, liquid cash, and stock, okay, standing at very strong balance sheet at $28.2 million itself. Okay, so lastly, our growth strategy focus on investing for a smarter future, continue to attract talent, digitize, okay, focus on our AI and ML, and expand our addressable market and offer to a more regulated product and service for our customer. Okay, so the market size is very big with the do it with me and do it for me market itself. So investment merit, okay, to summarize, market leader in Singapore, Malaysia with an Asia Pacific footprint, best in class wealth education programs. We have a financial advisory license for us to continue to expand, and we continue to apply license in various countries. Okay, large addressable market size, network effect, and a growing subscriber base. That's it for the update. Okay. Remember, we are 8VI. Thank you.
Hi, my name is Kath Whitaker. I'm the CEO of SelfWealth. I'd like to take this opportunity to tell you a little bit more about SelfWealth, and I believe the amazing opportunity that it presents investors. SelfWealth was started 10 years ago in suburban Melbourne. We've now grown a decade later to a platform which has recently been voted the most popular Australian equities trading platform. We now have assets in excess of $8 billion on our platform. We continue to grow from strength to strength. And what I'd like to do is show you here today the results that have been achieved, and more importantly, the very, very bright future that we see. What is our purpose? Our purpose is a simple one, and one that has existed from the day that SelfWealth started. We are about empowering people to achieve financial freedom. SelfWealth is a company of firsts. The first to introduce flat fee brokerage, the first to introduce ESG data to all members, which we deployed in September, and we will be the first platform to deploy crypto trading and equities trading on the same platform in just a few months. These are our operational metrics. As you can see, a consistent, solid story of growth. When you look across all of our operational metrics, we have grown the number of total active traders. Our cash balance continues to increase, which only speaks to the capacity that we have available on the platform. The volume of trades also continues to increase, and that equities under management also continues to grow, which is what we love because it shows that our clients' revenues are also increasing. When we look at our specific results from the last quarter, again, another standout quarter. Our revenues, now 5.5 million for the quarter, up 32% from the previous year. Our active traders continues to increase, and it's a really important metric, the active trader number, and something I want to draw your attention to. So at SelfWealth, we only include people who have not only registered on our platform, but people that have funds in their account or who are actively trading. That is a really big difference between us and other newer competitive players that are on the market. We look at the total number of quarterly trades, again, up 15% in the last quarter. You know, and the other thing that SelfWealth is doing extremely well is looking at the conversion of our existing traders and offering them new services. So for example, the introduction of US equities trading, which happened in December 2020, we're seeing conversion rates already of 31%. It's also worth reminding ourselves as well that during the GameStop period of February this year, SelfWealth was one of the very few platforms that stood up the entire time throughout the GameStop episode. We have one of the highest platform stability ratings in the industry. I also wanted to share with you just a few of the highlights from the last quarter as well, in addition to the fantastic numbers that I've just shared. SelfWealth is focused on community. We started as a community. What we want to do is to provide a low-cost, high-value platform where people feel welcome onto the platform. They can share their knowledge, share their experience, and we do that through independent thought leadership, engagement, and content. On a weekly basis now, we have on a Monday lunchtime over 2,500 individual investors dial into our live sessions where they can pose Q&A live at any time. We're executing on our strategy. We've deployed instant deposits, live pricing, and the integration of ESG data, all for free. The awards speak for themselves. These are just the latest awards from Finder Investment. We've also been expanding our market share, proud to be number 4 in Australia, with only 3 of the big 4 banks ahead of us. And we are intent on closing in on them and continuing to grow. What's coming up? Working very hard on cryptocurrency, which is progressing very well, and we will be introducing a new international market. I just wanted to share with you, for everything that we do at SelfWealth, it's about the voice of the client. It's about thinking about channel expansion, best-in-class experience, making sure that it feels personalized, and also continuing to add new asset types, which means new revenue streams from an investor perspective. So when I think about the valuation of SelfWealth, we know the opportunity ahead of us. We see infinite growth in terms of number of people on the platform, whether Australia or abroad. We think about wealth creation in terms of various asset types and breakout ideas. I've mentioned we are already proven a cash flow positive fintech, financial year 21, incredible result. But now we are focused on growth and investment. The SelfWealth approach has always been about community-driven, education and content, and we are all about data. data helping us make right decisions, and data in terms of providing the very best information in front of our investor community. SelfWealth truly is unique. We were the first multiple times, which is a tradition that I'm extremely confident that we're going to continue with. That market opportunity continues to grow. The addressable market, the number of retail investors coming in, only grows. And we are right there with people as they look for alternate ways to grow their money, as the housing market continues to be hot, interest rates continue to be low. We are there, and we're going to provide for them fantastic options in terms of how to build their wealth. So just to reinforce to you today, we want to share this information. We're hugely excited about the opportunity in front of us. We think it's an amazing opportunity for retail investors to get involved into SelfWealth. And we are the only listed, low-cost, high-value equities trading platform available in Australia. Thank you for your time and your consideration.
Good morning and welcome to Pioneer Credit's presentation for Wholesale Investor. My name is Keith John and I'm the Managing Director of Pioneer. Pioneer is an ASX-listed, Australian-based financial services provider that specialises in acquiring and servicing retail debt portfolios, predominantly out of the major banks. We operate in a sector where traditionally about 80% of all volume has gone to 4 players. In recent times, that's changed, and Pioneer is now the second largest acquirer of portfolios out of those banks in Australia. Our business model is based around being differentiated in the way that we both acquire portfolios, but more importantly in the way that we service them, such that banks prefer us over others and sell to us because we're seen as a very safe pair of hands that protects both the customer and our vendor's brand. Pioneer's differentiated approach starts with the way that we acquire portfolios. Focused again mainly on the big banks, we do not acquire lower customer segments like payday loans, for example. Our business is really focused on the higher performing segments, customers with a propensity to heal, and those that we can genuinely help. We have a strong range of relationships across all of the vendors in the market, and something that's very highly respected by Pioneer and by those vendors, such that we're always included in their conversations about what portfolios might be available for us to invest in. Our disciplined acquisition of these portfolios is really underpinned by our analytics and understanding what is a fair price that we can pay for them, such that we can make a commercial return, whilst also, of course, providing a very, very secure and safe service to the customers that we service. Ultimately, our business strives to do one thing very, very well, and that is to do the right thing all the time. That is in the way that we treat our people, the way that we look after our shareholders, our vendors, and of course, our customers. One of the ways that we demonstrate our differentiation is through Net Promoter Score. Pioneer has a Net Promoter Score of +23 at our most recent look back, and it's an amazing testament to the service that we provide to customers that are having a tough time. Our compliance regime is very, very solid and one of the things that differentiates this business from others. We're regarded and we're renowned for having a great offering that looks after our customers and also underpins the way that we represent the banks that we deal with. We have a board and a management team with extensive experience who are here to guide the business and also to protect shareholders' interests at all times. From a performance perspective, you'll see that over time, we've had great performance that continues to increase. One of the very key parts of our business is our portfolio. We've invested almost $500 million over the course of the last few years, and we recovered some $700 million to date, with much more to go. Our portfolio has a value of about 1.9 billion Australian dollars in recoveries that are due to us. And whilst we won't recover all of that, we do have a performing arrangements book, almost like a performing loan book, of about $370 million today, and about $1.5 billion that we're working through with those customers so that they can perform, and of course that we can get a commercial return as well. In terms of the outlook for this business, there's a range of programs of work that are going on. Of those programs, it is about underscoring the validity of this business and why we are successful. And from there, it's about increasing the operating leverage and releasing that such that more of the profits flow to the bottom line. One of the key aspects of that is we're currently undergoing a refinancing to reduce the cost of funding, and it's a program of work that we hope to have cleared and finalised in the coming months. Finally, in terms of outlook, Pioneer has guided the market to investment of $37 million. This is an amount that's less than we've invested in previous years, reflective of the changed environments caused by the pandemic. However, one that we expect to grow dramatically in the next couple of years. In terms of our earnings, we've guided the market to an amount that is EBITDA of greater than $55 million. And a lot of that money is reinvested back into our business, into growth. We thank you for your time today. Hope you enjoyed the presentation and look forward to welcoming you as a shareholder soon.
Hello, my name is Aga. I'm the founder and managing director of Primacy. We are based in Singapore. We have clients in Australia, Singapore, and South Africa. Regulation is changing every day. In fact, Australia recently has made 12 recommendations for the licensing of crypto companies. And if adopted, they will form a new environment that crypto companies will need to navigate if they want to continue to operate in Australia. We've seen similar regulations changes here in Singapore. For the last 2 years, the Singapore Central Bank, MAS, has introduced its own regulations, and this has constantly changed over the 2 years it's been enacted. But regulation is not just for the crypto world. In fact, every company operates under some sort of regulations, whether it be financial services, healthcare, or even not-for-profit organizations. The problem with regulations is compliance is hard. Compliance is expensive, and non-compliance can ruin your business. In fact, some of the challenges facing our businesses today is reacting to the volume of regulatory change, meeting regulatory expectations, and maintaining compliance policies and procedures. Compliance requires a lot of devoted time by people to process manual admin work. Most compliance offering currently available is only for large enterprise clients. Compliance management solutions are generally offered to large multinationals that have resources to meet their obligations. However, every company has regulatory obligations, yet traditional compliance solutions only cater for these large companies. They are expensive to adopt and complex to use. Fortunately, there is a better solution. Primacy is closing the gap between legislation and business. We help small to medium-sized businesses navigate heavily regulated environments by closing the gap between legislation and its obligations and how it's applied to business. At Primacy GRC, we've built a nimble compliance management solution that makes it easy for SMBs to design, maintain, and own their compliance program. We turn legislation into data so business can connect compliance controls to obligations and stay up to date with regulatory changes that impact them. So how big is the market? We believe the market is very large. In fact, the GRC market globally is over $100 billion. The technology market within that is $10.4 billion. And the platform market that Primacy plays in is over $2 billion. Primacy provides solutions sorely needed by SMBs struggling with the burden of compliance, but far too small for existing solutions. Primacy is affordable and easy to implement. So SMB is really a target market for Primacy. We believe so. SMB is the foundation of the world economy. It represents 90% of all business globally, employing 70% of the people and representing 55% of GDP of the developed countries. SMBs are an unmet market for the governance, risk and compliance space. Companies are looking to be competitive through technology. They're looking for solutions to help them scale their business without having to build complex infrastructure. Primacy is here to help. At Primacy, we've developed our own programming language. It allows us to turn legislation into data, which can create unique compliance solutions for our clients. In fact, we've applied for a patent of our invention for the programming language that we've developed. Primacy allows us to convert legislation into optimal, which allows us to create various compliance-driven solutions, such as governance, risk and compliance for the legal space and for human resource compliance. This allows clients to keep up to date with their business obligations, no more processing of compliance forms or manually dealing with compliance issues, saving our clients time and money. We've assembled some of the best management team from around the world. All the management have experience either in large multinationals or startups, from taking them from concept all the way through to listing. So why should you invest in Primacy technology? First of all, we were recognized as finalists in the Asia Pacific's Legal Innovation Technology Award 2021. We've also signed a multi-year contract with the ReNu Protocol to develop applications on their blockchain network for decentralized data storage, encrypted wallets, encrypted messaging, sending and receiving encrypted data. We've also signed a multi-year deal with Capital PFS in South Africa to provide HR compliance solutions for their 2,500 remote workers. We've also signed an exclusive agreement to provide Primacy GRC to a leading Singapore-based compliance consultancy with over 60 clients in Singapore, Malaysia, and Hong Kong. And finally, we were just recently accepted to the IoT Tribe London landing pad. This is a 12-week program subsidized by the Singapore government and sponsored by Enterprise Singapore and Economic Development Board Singapore to develop a go-to-market strategy for Primacy to enter the UK market. At Primacy, we're looking to close the gap between legislation and business to make compliance simple for SMBs. I'd like to thank you for your time and welcome you to join us with our journey. Thank you.
Thank you for joining us for the Emerging Small Cap Summit. Now, obviously, I imagine a lot of you are already in your trading platform, so feel free to, the companies which interest you most, feel free to check them out inside your trading platform. We've also got links on that we've sent through in the emails prior to this, both in Chris Media and also on Wholesale Investor, so there's information there for you. I hope you enjoyed the event and I hope you took a lot of value away from the panel sessions. As I said, it's a great opportunity to hear from both the fund manager and also the deal maker side. Now, let's talk about 2022. For this last 18 months, said as a company, and also I know you personally, all of us have had pretty much everything thrown at us about changes, variations, and all that sort of stuff. As we're sitting here looking at 2022, one of the things that excites me most is the return to actually live events. And it's funny to say that after doing it for so long, you think to yourself, oh, it'd be great to get a break from it. The break has just been a little bit too much. This is our opportunity where we're going to be putting on Emergence 2022 in person at the Fullerton Hotel in Sydney, and you are invited. We want to make this special. I said, well, it's the most beautiful thing about the last Emergence we did. We had nearly 2,000 attendees come along to it across 3 days, and it was a special event. If you've never been to an Emergence event, the buzz is unforgettable. The people, the deal making, the conversations, the networking, the companies that are coming along. There's just this hub of activity that's very, very hard to describe. Plus, we also throw some pretty cool private after parties as well. So I highly encourage you, be on the lookout. We are going to be launching Emergence 2022 soon. Said, whilst most people have been enjoying sort of that flexibility and working from home and doing more stuff from home, I highly encourage you, this is your opportunity to come out, dust off the suits that we probably all haven't worn in such a long time, come out, and enjoy Emergence 2022. We're talking in early to mid-March, with the dates will be coming up shortly. And I said, for our perspective, this is such a nice opportunity to bring back the ecosystem together. I know we're all over Zoom meetings, and I know we're craving for that sort of contact, that deal making that we know and love, right? So Emergence 22 is the next destination for that. Make sure you register for it, put it in your calendar, clear out those 3 days. It will be unlike anything that we've experienced over the last 2 years, and we know that for a fact because we've been locked up at home. For those that are looking to travel internationally, we highly welcome you to do it. Obviously, the restrictions will be gone now and you'll be able to actually come to Australia. We are super excited about hosting this event. From the entire team's perspective, we actually look forward to moving away from the camera and actually meeting you in person again and enjoying live deal making, live networking, and live presentations. Enjoy the break, and I hope you enjoyed today's session.